Smith alongside Alexandra Canal this morning. This is Yahoo Finance's flagship show, The Morning Brief.
Stock futures rising as the major averages look to recover from Wednesday's declines. Wall Street is tracking a robust GDP revision as well as Nvidia earnings that didn't quite impress investors. So let's get to it with the three things you need to know to start your trading day. Yahoo Finance's Dan Howley, Jared Blickery, and Brooke DePalma have more.
Nvidia shares are trading lower despite beating or meeting expectations on nearly every single metric. The AI giant posting 122% revenue growth and 168% profit growth from last year. Nvidia's all-important data center business more than doubled its revenue from a year ago, but none of it was enough to push the company's shares into the green. Wall Street has high expectations for the AI leader, and revenue guidance for the third quarter, though a beat, disappointed. And fears over production delays of Nvidia's new Blackwell chip were not completely assuaged, with the company's CEOs saying Nvidia executed a change to the chip to improve production yields. Jensen Huang reiterated the excitement around the chip.
Hopper demand remains strong, and the anticipation for Blackwell is incredible.
Salesforce CEO Mark Benioff touting the company's AI initiatives after beating on sales, operating margins, and earnings in the second quarter. In an interview with Yahoo Finance, Benioff teased the coming launch of Agent Force, which features AI sales agents that can go beyond what chatbots can do to resolve customer issues.
Why this is important for our customers is it's going to give them a level of productivity and automation that they have never had before.
Shares of Salesforce are higher following the upbeat results. This is in stark contrast to just 3 months ago when the company shockingly missed sales estimates for the first time since 2006.
And the U.S. economy growing at a faster pace than expected in the second quarter. The second revision for the quarter clocking in at 3% versus the 2.8% economists expected. That's according to the Bureau of Economic Analysis. The data potentially a good sign for the Fed that growth is not slowing too quickly. Meanwhile, initial jobless claims nearly in line with expectations at 231,000 claims versus the 232,000 expected. That's down just slightly from the prior week's revised level, but we did see an uptick in continuing claims, but overall still seeing signs the labor market is cooling, but not rapidly deteriorating. U.S. futures are higher as markets look to rebound from Wednesday's decline.
Our top story today, Nvidia reported its sixth consecutive earnings beat after the closing bell on Wednesday, and that's thanks to ongoing demand for its AI chips. Shares, however, are fallen, as Alicia Keys would say, down by about 3% after the chip maker said it expects third quarter revenue to come in around $32.5 billion. For more on why this is a key concern for investors and broader markets, we've got our very own tech editor here at Yahoo Finance, Dan Howley. Hey, Dan.
Yeah, there were three things that investors really didn't seem to like from the earnings. The first was the street seemingly wanted a bigger beat, and sometimes your best just isn't enough, right? And so that's seemingly what we saw from Nvidia here. They beat on expectations, they beat on guidance, and still we saw shares drop as much as 6% at one point immediately after the earnings announcement. Now they're down just around 3%, a little more than that. And you know, I think it comes down to the fact that they just weren't the exciting, stellar, blow-away kind of results that we had seen in the prior quarters. And ahead of the earnings, I had kind of spoken about how investors may see a beat of 100% and not be as ecstatic. If you look at the data center revenue growth from the prior quarters, we'd seen 400% plus growth. It's tough to go from 400 to 200 or so or 100 or so and then still feel excited. They're still growing, though. The other thing that I think Wall Street is looking at is the Blackwell delays. And so the information reported there were delays. Now they said, CEO Colette Crescent said that they made some changes to the mask of the chip itself. Jensen Huang said, look, it's out there, it's sampling, it's working. We're going to get it out there. Here's what he had to say.
We executed a change to the Blackwell GPU mask to improve production yields. Blackwell production ramp is scheduled to begin in the fourth quarter and continue into fiscal year 26. In Q4, we expect to dip several $billion in Blackwell revenue.
So that's Colette Kress, CFO, several $billion in revenue. But that brings us to the third thing. There wasn't a lot of clarity. Analysts on the phone had asked what that means exactly. How many billions of dollars can they expect? What's going on there? And there was no real answer from Kress or Huang. And so I think some people were expecting, give us a number, give us an idea as to what the excitement around the chip is, but that was a no-go so far. So they say that they'll have it in Q4, those billions in revenue. I think now it's just a matter of waiting to see what that finally looks like when they do put that number out.
And that lack of clarity likely contributing to the share declines today. Nvidia shares down about 3%. Thank you so much, Dan, for the breakdown. Investors are questioning whether or not Nvidia can keep outperforming its past growth, and our next guest is raising some concerns about Nvidia's overall valuation. Here with her take on the latest results is Beth Kindig, IO Fund lead tech analyst. And Beth, look, we did have lofty expectations heading into this report. Nvidia, it did deliver, but not at the level that Wall Street was expecting. So it's now the time for investors to recalibrate their expectations when it comes to this company.
Hi, so good to see you the day after NVIDIA reported. I would push back on that. NVIDIA had a great report. The information had reported, this is a media outlet, that data centers would not be stood up in Q1. That would run into Q2, completely thrown off the table last night. Several billions of dollars of Blackwell in Q4. Data centers will be stood up in Q1. That is what investors were expecting. That is what Wall Street was expecting. That's why things are being revised up, and they were never revised down. Wall Street obviously is very closely tied to estimates, and we never saw revisions downward based on the so-called delay. That's what you want to piece together here is NVIDIA coming in according to what Wall Street's expectations are, or are they beating? They beat, and they're saying Blackwell is basically on time. So I would push back on that. We cover this stock very, very closely. Blackwell is not a concern. If anything, it's extremely bullish. There are some production numbers buried in their report, up 48% quarter over quarter. Could not be more bullish in terms of Blackwell. Now, the valuation, when you have a high flyer like NVIDIA, can get stretched at times. Going into the print, we warned our members that this valuation is looking a little toppy. What we need is for the fiscal year estimates next year to go up. So we're in a waiting game for analysts to revise their estimates upward, which eventually they will. But until then, the valuation is stretched.
Okay, so if the valuation is stretched, then where does that put them on the pathway towards reaching some of the targets that you've set forth? You have some of the kind of loftier long-term expectations on a market cap front for NVIDIA. I believe we were talking about $10 trillion last time you came on. And so for NVIDIA to really hit that in stride over years, what do you see as the pathway towards growth into that?
The pathway to growth is to pay very close attention to NVIDIA around the fiscal year guide. That is always NVIDIA's big moment, number one. Number two, the second biggest moment of the year for NVIDIA will be when Blackwell is shipping in volume. This will be your Q2 report, but we'll get some signs in Q1 with that forward guide. It's going to be fireworks is how I would put it. Absolute ultimate fireworks for Blackwell will come in Q1. With that Q2 guide, you have to really realize that these guys are on a product release cycle. Therefore, Hopper was out, roughly 2 years ago, began shipping in October. Stock was down 60%. The following Q1 and Q2 report in 2023 were blowouts. So you have to understand that there's a shipping cycle that occurs for this company. Some media outlets have blown that out of proportion. It's absolutely on time. Early next year will be fireworks again for NVIDIA, and we will be on track for that $10 trillion.
But Beth, even outside of Blackwell and whenever those chips do get delivered, what about some of these hyperscalers when they feel like they have enough, right? When they stop spending as aggressively on these chips, what happens then to NVIDIA? And when do you expect a deceleration in growth? Because that seems to be more of a story on Wall Street right now.
That's a great question. They were asked that last night and they answered quite succinctly, and I'll try to summarize it for you because it was a little lengthy in terms of the answer. And I also do know the answer, which is that they're in a race toward preventing extinction between these big tech companies. You have to understand that whoever gets there first could completely dominate to a level that the others would decline on their business quite substantially. So this is a matter of survival. This is not a matter of some cute little applications that consumers might use. One of the most important comments that was said last night to help understand this, why big tech is spending so much, is they said most of the GPU capacity is going toward their own applications. There's not a lot available for enterprises and startups right now, which means they're hogging it. They're hoarding it. Google and Meta and Apple and these others that are buying GPUs and custom silicon, they're using it for their own businesses. That's key because they're not even at the point yet where they're trying to leverage an ROI on their cloud infrastructure.
Beth, just lastly, while we have you here, I mean, the stock has been said to have run too fast and too quickly, grown too, just parabolically, unfortunately at this point, but also good for Nvidia. I mean, has it run up too quickly at this juncture to sustain investor appetite to dive in at this level?
Yeah, welcome to tech. And there will always be pullbacks, and we are in a lull, if you will, in the product cycle, completely expected, but a lull. And we do believe we will see Nvidia trade lower.
All right.
And we plan to pounce. So I would say buy up. Our message has always been buy on the dips, and that continues to be my message.
All right, Beth Kindig, who is the IO Fund lead tech analyst. Beth, good to catch up with you once again. Thanks so much for taking the time.
Thank you.
Certainly. Speaking of AI, a bounce back quarter for Salesforce, the company beating Wall Street estimates on sales, operating margins, and earnings here. The CEO, Mark Benioff, touting the company's AI initiatives in an interview with Yahoo Finance. Take a listen.
It's a dramatic transformation and opportunity for really all of our customers. And it's very simple, Brian, really. For the last 25 years, what have we been doing? We help our customers build and run their sales forces, their service forces, their marketing forces, their commerce forces, their analytics forces. And now we're going to help them build their agent force. And why this is important for our customers is it's going to give them a level of productivity and automation that they have never had before.
Shares of Salesforce moving higher this morning here, and it was interesting listening into the earnings call. I mean, for those of you that thought the only beef that you would hear this year was between Drake and Kendrick Lamar, well, ultimately there's some co-pilot beef between Microsoft and Salesforce here. They talked about this on the call and saying that you really have to have your hands on the technology to understand this. This is not co-pilots, what Salesforce is trying to deploy here, saying that so many customers are disappointed in what they bought from Microsoft co-pilots because they're not getting the accuracy and the response that they want. Microsoft has disappointed so many customers with AI. That's said by the executives from Salesforce on the earnings call. They also kind of gave this analogy of Salesforce being like a Waymo for your customer information and automating your company, that is, as of right now. So we'll see if that actually sells within this environment where there still is increased deal scrutiny right now, but Salesforce still looking to add on and really sell the agent force story that they have right now.
Yeah, and look, this was a comeback quarter for Salesforce in a lot of ways. We saw in the first quarter the first revenue miss from the company since 2006. Wall Street had a lot of questions about the traction of where AI products could be heading. There was this overhang question of whether or not this print would be enough to really reinstill some of that confidence. And if you take a look at shares since the start of the year, heading into this report, they were mostly flat. But there has been this bullish embrace as of late with CEO Mark Benioff. He's running the business more efficiently. It's no longer a strategy of growth at all costs. But the company still has a responsibility to invest in AI. And I wonder moving forward if there's a risk-reward skew there when it comes to making sure you're not spending too much, but also investing aggressively in some of these AI opportunities, because that seems to be a long-term play there for Salesforce and a key question moving forward. But this does set up Salesforce in a good position heading into the back half of the year.
Yeah, none of this is possible without the AirKits.ai acquisition that was made here and really integrating that Einstein service agent with AirKits.ai and saying that now being the major driving force behind Agent Force. So many forces here that we're talking about. But that is going to be something that we hear a little bit more about from Dreamforce in just a few weeks here, too.
Yeah, coming up.
All right. The U.S. economy grew at a faster pace than expected in the second quarter. The second revision for GDP clocking in at 3% versus the 2.8% economists had expected. That's according to the Bureau of Economic Analysis. Now, the data potentially a good sign for the Fed that growth is not slowing too quickly here. Now, here with more on his take here, we've got Robert Socken, who is Citi's senior global economist here. Okay, so latest GDP revisions. Also, thank you for coming in studio here with us today. Great to see you. First, as we think about what these GDP revisions mean for how the Fed is really evaluating the economy as according to their dual mandate here, is there anything that they could take away from this that would move their policy direction one way or the other in September?
Yeah, absolutely. And thanks so much for having me. It's a great question. On the one hand, these data are a bit of old news because it's in the second quarter. We already knew that growth in the first half was fairly strong. It was a modest revision higher. So in terms of that, a bit of old news, although still good news. But on the other hand, one thing that you see in these data, and you've seen that continue into the third quarter, is the consumer still looks to be holding up pretty well. You saw solid consumer spending in the first half, and we've had 2 strong months of retail sales in recent months. And so right now you're getting wobbles in the labor market. That's the biggest concern. But so far the consumer does not seem to be rolling over. So that would be my major takeaway from the first half data and what we've seen from the consumer in the third quarter so far.
So how are you looking at the potential risks to the economy right now? Because there's still the unknown factor about the Fed. There's still the election. Yes, the consumer's holding up, but we have seen some signs of a more choosy consumer. So how do you see that all playing out when we think about growth through the end of the year and into 2025?
Yeah, absolutely. And this is the key question because the risks, I think, are more skewed to the downside in recent weeks. You've seen our Citi Economic Surprise Index that looks at how data are coming in relative to expectations. That has fallen sharply in the third quarter, and data, broadly speaking, have mostly missed the mark and come in below expectations. Now, that being said, growth was very strong over the last year, so expectations may have been a bit too lofty, and it's not necessarily a recessionary signal on its own, but it does show that things are slowing down. And the question becomes, are we slowing down into a soft landing, or are we slowing down into a recession? I think, as I said, the balance of risks have shifted more to the downside. But to me, the data still feel more like a soft landing. You're still seeing decent consumer confidence that picked up in recent data, decent consumer spending. And if you look at some of the high frequency indicators we saw this morning, jobless claims are still really low. So there's some question about how much is the labor market loosening, but so far you're not really getting those layoffs. And I think that's what you really need to see for this economy to show signs that it's really turning down sharply.
And so what would that translate into the unemployment rate if we're kind of looking at and zeroing in on the employment situation as a barometer for whether or not we've actually struck and are in a recession, which won't be called until well after we've actually seen
it. And that's the exact challenge is how do you know when you're in it, if you're in it? And, that's what got a lot of focus early in August because the employment report, the unemployment rate moved up to 4.3%. It triggered the SOM rule, which historically has been an excellent barometer for recessions in the post-war period. But that being said, this time could be a little bit different in that much of the rise or a fair amount of the rise in the unemployment rate has been due to increasing labor supply rather than weakening labor demand. So for the unemployment rate, it's possible it could move up even further from here for quote unquote good reasons that more people are coming into the labor force. Now, in terms of what that means for the Fed, I think it's very challenging because they know the SOM rule, they know that's a predictor of recessions or an indicator you're in recession. And if the unemployment rate keeps moving up, even if it's for more people coming into the labor force, I think it's going to be very hard for them not to get worried about those recessionary risks. I think they'll start moving very aggressively. So it's a very tricky balancing act right now. You could be getting good moves up in the unemployment rate, but it's hard to tell when you're in that moment.
So let's zero in on the Fed because post-Jackson Hole, I've seen a lot of commentary from Fed officials that it's more important about the pace of rate cuts and not the amount. Markets are pricing in about 100 basis points worth of rate cuts. Do you expect that we'll get that by the end of the year? Or do you think the Fed's going to be more methodical in the approach? And does the Fed have the luxury to be methodical at this point?
Yeah, and it's really challenging. So, and there's a heated debate within our own economics group about how fast they'll move and what's happening to the U.S. economy. As I mentioned, a lot of the rise in unemployment rate has been for quote unquote good reasons or better reasons, people coming into labor force, but it's still concerning how much the unemployment rate's moved up. And so from a risk management perspective, that might lead the Fed to be a bit more aggressive in its initial moves, especially if they think there's a high risk that the economy is slowing down sharply. So, our U.S. team is looking for them to start off with 50 basis points and another 50 after that. So they actually have 125 basis points for this year from the Fed. Now, if you look around the world, most central banks have opted for gradualism in this cycle. I mean, if you look at the ECB, they did one cut and then they paused. And you've seen that from other central banks like the Bank of Mexico. So this has been a very gradual, cautious cutting cycle because I think central banks don't want to lose those hard-won gains that they had on inflation from earlier in the cycle. So I think right now it's hard to tell. Markets are pricing in a decent probability of a 50 basis point cut, but the base case is 25. To me, that feels about right, but we'll see how that next employment report comes in. I think, again, if the unemployment rate moves up more from here, it's going to be very hard for them not to move more aggressively.
We'll see that employment report, and then also in a few weeks, that Fed meeting in September. Robert Sotkin, Senior Global Economist at Citi, thank you so much for joining us.
Thank you.
Coming up, a slew of retail earnings hitting the wire. We get the read on the state of the consumer next. You're watching Morning Brief.
Best Buy shares are surging here as the retailer beat expectations, but seeing comparable sales down. Appliance, home theater, and gaming weighing on those sales, but investors focusing on sales growth in other areas, including tablets, computing, and services here. Shares are up right now, nearly 15% here pre-market. We'll be generous and round that up to here. And for me, there was a little bit of relief within this. It's not as bad as it could have been. Looking at the entire environment for consumer technology, whether it's people that are waiting for the latest iteration of technology that has the generative AI elements in it. Some of those going to be either announced or unveiled in September from Apple. So we'll see what that does in the market. And then more largely, it's been tough for appliances parts of these businesses too, because then you're really banking on some of the home projects, the DIYers that are saying, all right, well, I can connect a new fridge by myself. I'll just get it from Best Buy. I don't know if they have a geek squad that takes care of your fridge too. But anyway, all these things considered, not as many people going into some of the larger appliances or larger electronics if there's not a new home that they have to put it into as well here right now.
Yeah, and there are some tailwinds, I think, for Best Buy when you think about just back to school, the upgrade cycle, artificial intelligence leading to more technology, more things that people want to go out there and buy. And then as you were alluding to, really when the home buying market picks up again, when interest rates fall, maybe that could help with appliances as well. But moving on to another trending ticker, Dollar General shares plunging, heading towards a 10-month low. This after the discount retailer reporting second quarter per share earnings and quarterly revenue that missed forecast. The company also slashed its full year outlook, citing a quote, financially constrained core consumer weighing on sales in its latest quarter. And Brad, as we've been talking about the state of the consumer over the past several weeks, there is this bifurcation that we're seeing, especially when it comes to higher end consumers, lower income consumers, and really the types of companies that are holding up well versus others that are plummeting. Dollar General, I mean, it's looking to lure consumers with good deals, but that core consumer is that lower income. And we see that cohort of buyers really pulling back spending dramatically, not to mention the increased competition in the space, like with a name Walmart. I mean, how does Dollar General compete with that, especially since Walmart has really turned into this one-stop shop for folks? So a very difficult task for this company to really turn things around at this point.
Yeah, the only thing I'll call out here, operating profit decreased 20.6% in this quarter. And so that is something that we have to keep an eye on in addition to the pressure that the consumer is seeing, especially on the low income group part of this broader economic makeup here. And so we'll see how Dollar General is able to continue to navigate that. Let's also talk about some PCs here. HP and Dell shares, they're sinking pre-market. For HP, they cut the full year profit outlook and reported a mixed third quarter report. The report weighing on its competitor Dell as well. That company reporting earnings after the bell today, so we'll see what they have to say. HP's printer sales hurt its earnings, but its PC sales rising more than expected. We spoke with Enrique Lores, who is the HP CEO, on Thursday, and he was optimistic about the future of its PC business. Here's what he had to say.
We expected them to be 10% of the market in the second half, and we think we are going to be above that goal as we complete the next 2 quarters.
Yeah, so HP is optimistic over the long term when it comes to artificial intelligence. Coming up, though, we are counting down to the open of the trading day, and we're going to discuss that with Megan Horneman of Verdance Capital. You're watching Morning Brief. That's up next.
Just seconds away from the opening bell on Wall Street and in Midtown Manhattan at the Nasdaq. There you're taking a look at the futures. We are higher across the board right now. You got GDP revisions. You got earnings reads out this morning. We'll continue to break some of those down. And you got bell ringers, ladies and gentlemen, boys and girls. Metropolitan Commercial Bank celebrating what looks to be like 25 years. And at the Nasdaq, you've got Cogent with the opening bell there. Ticker symbol CCOI. All right, funfetti in the air and market gains almost everywhere, at least across the major averages as we begin today's trading activity here. We're zeroing in on the S&P 500 out of the gate. As of right now, it's up by about 0.4%. Nasdaq Composite, you're also seeing that up to start things off. It's up by about 0.3%. And the Dow Jones Industrial Average, that too, seeing some gains, up by about 0.7% right now.
Yeah, and I want to highlight the VIX, the volatility index. That's edging higher today. We have seen Nvidia shares struggle after those lofty expectations. Also, if you take a look at the 10-year note, edging slightly higher today, trading around 3.8% ahead of that core PCE inflation data. That is the Fed's preferred inflation measure. So that's going to all factor into what we see with that September rate cut. But now let's get to Yahoo Finance's Jared Blickery for a look at what's moving today. Jared, what are you seeing?
Thank you, Allie. I was just watching the small caps because they've had kind of a rough go. They've been underperforming. And meanwhile, the major indices really haven't done much this week. It's just been a lot of chop. And that's probably fine by investors, as this is the prelude to a holiday week. A lot of people are already on vacation. Here's the last few days, the last 4 days to be specific. Here is a year-to-date chart. And really to show you the entire picture on small caps, I got to give you a 3-year picture because that's the last time we had a high. And there's a 5-year that kind of paints things and rounds things out for you. But we've just been in this giant consolidation and we might have more time to go. So for all the talk about small caps, when are they going to lead? I'm holding my breath as well. So I also want to highlight the US dollar heading higher. So is the 10-year. That could have important ramification for sector action, but I'm not really seeing it just yet. Here's consumer discretionary. That is up 1%. That is in the lead. That's XLY there. Energy is number 2. That's XLE. To the downside, we only have real estate and staples trading in the red. And let me just show you what's happened this week. On a 4-day chart, you got financials up 1%. Tech down just over 1.5%. Consumer discretionary, that's Tesla, that's also Amazon in there. That's also lagging. So the mega caps really lagging a little bit here today, this week. And then on a year-to-date basis, I think it's interesting that communication services, financials, and utilities, these 3 sectors up here are the best performing sectors. So utilities right up there with financials. Did not expect that. Let me just round this out by looking at the Nasdaq. We see Nvidia, that's down 2.5%. That's a stock everybody's watching today. But for an earnings report, that was a little bit of a disappointment. That is not a big move. The options market was pricing in a 10% move. So kind of a gift to investors, at least if you're on the right side of that volatility trade. Also, Supermicro has been really interesting. I do want to point out that stock is now down 60% from its record high, which was very recently. Here's a 1-year chart. Here's that record high, down 60%. But you'll see on a 1-year basis, still up 73%, and year-to-date, up over 60%. Guys?
Jared, thanks so much. Teeing up today's market activity. Appreciate it. Well, the dust settling after Nvidia's solid but disappointing earnings report by some measures. Now traders digesting the latest GDP data out today, showing the U.S. economy growing at a stronger pace than expected in the second quarter. To discuss what this means for broader markets, we've got Megan Horneman, who is the Verdance Capital Advisors CIO. Megan, great to have you back on the show with us. I mean, we know coming into today's trading activity, we were all going to be focused in on exactly what Nvidia had to say, as it has been really the leader and contributor to so many of the gains that we've seen so far in 2024. But now, even with Nvidia down by about 2% during today's trading activity and the major averages seeming to still hold on to gains, is this the broadening out that we've been talking about for so long?
I do think this rotation has some legs to it. I think you'll see that, especially as the earnings, not only for the last quarter, but even the next quarter come in, and these beating expectations by the numbers that we've beaten in the past. It's just not sustainable with that AI momentum trade. I think you'll see some broadening out until we get further evidence that the economy's slowing, and that's our concern. The GDP number that we got today, again, it was backward looking. It's very surprising to me that the consumer is is still driving GDP, given the level of debt that they're carrying right now, as well as the high interest rates that are starting to filter into whether it's confidence or now delinquencies rising. I don't think that's very sustainable either. So I think as we get into the fourth quarter of this year, it's going to be a much slower economy. And I think some of this equity euphoria around rate cuts may lose some momentum.
Okay, so you're citing some of those risks that you see playing out in the market over the next few quarters here. But when you think about a name like Nvidia and all the volatility that surrounds that, coupled with those risks that you were just outlining, how do you hedge your bets as an investor? How should people be operating in this environment, especially since we likely will be seeing a rate cut in September?
Well, first of all, when it comes to some of these names that have really driven the S&P 500 higher, make sure you're not overweight to where you want to be. So rebalance your portfolios. Make sure you're back in line where that allocation should be. Also have a good amount of cash on the sidelines to be able to put to work. When you look at some of the areas of the market, small and mid-cap stocks, they have caught up a little bit here lately, but they're still much weaker when you look at it compared to the large cap performance. These are the areas of the market that will rally the most out of an economic downturn. Those are some that we're looking to possibly add some money to. It's a little early yet because the economy is really just starting to show some weakness in the numbers that we've gotten. The best time to do that is when you've really, confirmed that we're well within in a recession. They're going to be the best ones to rally out of that.
A much more popular acronym that we're continuing to hear is BOTD, buy on the dip. Where are the most attractive dips that you would be keeping an eye on, Megan?
So I think if you look at the S&P 500, we saw it a couple months ago where we had about an 8 or 9% decline. We saw small and mid caps down about a 5% decline. I still think we could be in for at least a 10% decline in the large cap indices. We'll look at that point. But the one thing that we need to see in conjunction with that decline is that they're getting a little bit more realistic on earnings expectations. Earnings expectations for 2025 are still way too unrealistic in our opinion. You can't have a slowing economy, a Fed that's cutting rates because we have a slowing economy, but yet have double-digit earnings growth for next year. So when we see earnings growth revisions come down, as well as that dip, that's when we'll look to put money to work.
PCE inflation data is out tomorrow. That's the Fed's preferred inflation gauge. Do you expect to see the trend of disinflation continuing? And when you take a step back, there are still some very sticky areas of inflation in this market, like core services and shelter. So what's the battle that the Fed faces when it comes to tackling that while also lowering rates?
It's a battle for sure. That's where I think the Fed has to be very careful about how dovish they deliver these rate cuts. If they get too dovish, it's very easy to reignite inflation, especially in those sticky areas, like you mentioned, in services. Service inflation is still growing well above average hourly earnings on a year-over-year basis, and well above what the Fed's comfort level would be. So they can cut rates. We think that that's definitely likely they'll do that, but they have to be very careful about how they walk that line on articulating whether this is one cut and then six cuts right after that, or if this is one cut and let's wait and see.
What do you believe that policy pathway could look like, the pacing of those cuts?
So, what I would like to see and what may happen are two different things. But I think that the Fed, can deliver a 25 basis point rate cut in September. I think that they should deliver a wait and see statement with that. I think that trying to articulate that they'll cut again in November and then again in December, it's way too early to say that. The labor market is weakening. We've seen that over the past 6 months with the unemployment rate rising. But on an absolute basis, the unemployment rate is still well below what we tend to see going into the first rate cut of a rate cutting cycle. And inflation, while it is starting to move in that direction and we're getting close, as I mentioned, there still is a lot of sticky inflation out there that could cause a bit of a headache here for the Fed. So they have to be very careful. I think they should deliver 25, a hawkish statement, and then just say, we'll wait and see. There's a lot of information between the September meeting and when they meet again in November.
Megan Horneman, who is the Verdance Capital Advisors CIO. Great to see you here. Great insights and analysis as always. Thanks, Megan.
Thanks.
Coming up, everyone, shares of CrowdStrike taking a hit after the company's massive IT outage last month weighed on its outlook. We've been continuing to keep tabs on that stock as well here. Up pre-market, or during the early moments of today's session by about 6%. You're watching the Morning Brief. We've got much more on that.
Cybersecurity firm CrowdStrike, which suffered a major IT outage last month that disrupted industries worldwide, has lowered its full-year revenue guidance in the wake of the disruption. Shares moving higher after the company reporting 32% revenue growth year-on-year for the prior quarter. Joining us for more is KeyBank Capital Markets equity research analyst Eric Heath. Eric, this seemed to be a report that came in better than feared, especially given that outage. And we did hear from CEO George Kurtz on the earnings call addressing this. Take a listen to what he had to say.
The magnitude of the July 19th incident will never be lost on me, and my commitment is to make sure this never happens again. The days following the incident were among the most challenging in my career because I deeply felt what our customers experienced. Our mission is alive and well, and I know that CrowdStrike's very best days are ahead of us.
So, Eric, judging from the share price reaction, it seems like investors were happy with that reassurance along with the earnings beat, but we did see a modest cut to guidance. Do you view the outage as a short-term blip for CrowdStrike, or will this be more of an overhang that lingers into 2025?
Yeah, thanks for having me. And I do think this is a short-term blip that's going to be an overhang, but it's unchanged in terms of the long-term prospects for CrowdStrike and the opportunity that sits in front of it. When we talk about the consolidation story. So you heard it from George himself right there and last night, but I think what resonates really well is the message from George on the corrective action they're taking to make sure something like this doesn't happen again. And we also got some early encouraging data points to suggest that customers are showing a vote of confidence in the Falcon platform, in the retention rates that have been fairly steady in the 5 or 6 weeks ensuing since the outage, and the number of large transactions and deals that CrowdStrike was able to sign even following the outage, which we think speaks volumes to the customers taking to heart the message from George, the quick transparency and corrective action they've taken. And we think customers are going to want to continue to do more with that Falcon platform going forward.
Do you think, though, it may impact some of those net new customers? I mean, having worked at a software and enterprise software company in the past, I know that a lot of those deals that sales teams are trying to get done, they don't typically make it up to the level of a CEO to get sign off or the board of directors to get sign off. CrowdStrike had to acknowledge that on the call. So what does that mean for some of that deal scrutiny that they could be facing to acquire new customers as well?
Yeah, I think new customers and existing customers alike, they're going to be asking the same questions. But what I think still rings true and what people, investors and customers take solace in is that CrowdStrike still is the leading cybersecurity vendor when it comes to preventing breaches. So we think that's going to be unchanged. Now, while there might be some more questions to make sure that corrective action has taken place to make sure an outage like this can't happen again, we still think customers are going to continue to hold CrowdStrike in very high regard when it comes to making sure that they are preventing breaches and they are providing the best cybersecurity.
Eric, what letter grade would you give George Kurtz and his leadership throughout this turbulent time for the company?
Yeah, I'd say I'd have to give him an A here. We've seen other instances with other software vendors that have had incidents to different degrees and in different nature. And what I think really resonates well with customers, and that's what we're hearing in the field, in conversations we're having, is that transparency, that quick communication does go a long way with customers, because customers understand things happen, but it's the way you communicate, it's the way you react, and the way you commit going forward to be better. And so to that degree, I'd give George a pretty good grade here.
When you think about the number of investments that companies are making in generative AI right now, for CrowdStrike, it seems like this should naturally be an easy win with the number of companies that also need cybersecurity layered on top of that. How are they, and how does it seem like they're being able to sell that successfully into their portfolio client base and then some of the broader customer base they're looking to onboard?
Yeah, it's an excellent point. And I still think we're early days in terms of figuring out exactly what it means to use Gen AI for security defenses, as well as actually secure the use of Gen AI. So it's still a very dynamic situation. But what I'd say is exciting is the opportunity that lies for CrowdStrike to use Gen AI to enable efficiencies within security teams, to drive greater efficacy, to make sure bad guys can't get in. And we think that Charlotte AI product, that is a Gen AI based product, we think that has a lot of opportunity to drive a lot of efficiencies in what's still a challenging burden that security teams face to make sure they can respond to all these breaches and do so effectively. So we think Charlotte AI is something that's potentially a meaningful contributor going forward to the portfolio.
And Eric, the cybersecurity landscape, it seems to be moving more towards fragmentation. What kind of market share does CrowdStrike currently have? And has the outage impacted that market share at all or leveled the playing field in any way?
Yeah, so I think big picture, we don't think the broader trend towards consolidation. We think that the current environment today is very fragmented. And we think the multi-year trend here is towards consolidation. And that's the really exciting opportunity when it comes to CrowdStrike, is they are a leader in endpoint security, but they're still very early days in broadening into other very large and strategic markets in cybersecurity. And one metric they gave last night to show that momentum that they have is some of the early emerging modules that they offer in cloud security, in analytics, in identity, these big strategic markets. That's collectively hit $1 billion run rate in revenue and still growing at a very healthy double-digit clip. So customers are showing that they're willing to do more on the Falcon platform, and we still think it's really early in terms of that market opportunity.
Eric Heath of KeyBank Capital Markets, thanks so much for taking the time here today, talking all things CrowdStrike. We appreciate it.
Thank you.
Certainly. We're taking a look at Yahoo Finance's trending tickers and breaking down why they're moving in 30 seconds or less. That's right after the break. We're taking a closer look at Yahoo Finance's trending tickers. Birkenstock, Five Below, and Big Lots. We're doing it in 30 seconds each. Let's go for it. Birkenstock shares, they are, hey, get this one, sliding this morning. The shares are down by about 13.5%. The sandal maker's third quarter numbers falling short of analyst expectations, leaving its full year outlook unchanged though here. The revenue did grow 15% in the Americas and overall rose 19% worldwide here. However, just a little bit low the FactSet consensus here. And then ultimately, they did stand by the fiscal guidance, as we mentioned, for 2024, still looking to grow revenue and 19% on the expected basis there.
Yeah, and this is a pretty tough market, right?
Yeah.
I feel like the shoe market is so heavily penetrated. Do you have any Birks? I have a couple Birks.
Just the rubber ones.
Just the rubber ones. I have
the
the rubber
low-end
ones,
ones.
and then
yeah.
I have the sandal. And it's interesting because they said that revenue growth benefited from increased sales of closed-toe silhouettes.
Yes, I can see that. I can see that.
So
It's showing up in my feed.
Is that showing up in your feed?
It is, yeah.
Is the Gen Z TikTokers moving into that realm, perhaps? I don't know.
I don't know. It's kind of it's tough to know if they're Gen Z or young millennials these days.
Yeah, so it's one of those things that stood out to me because when you think about innovation in the shoe space, that's something that you know these different companies are kind of leaning on their products that maybe didn't bring them to fame, but perhaps need them to come back around. Who knows? But full year outlook, as you said, is maintained. Moving on to another one, Five Below shares. They're in the green today. The discount retailer's second quarter sales beating the street's expectations. Now, this is really a better than feared report here. So bucking the trend of what we've seen from some of the other discount retailers like Dollar General today, earnings coming in line with consensus estimates, a beat on revenue. Comparable same-store sales, that's a key metric for many of these retailers, down 5.7% in the quarter. This was ahead of expectations of a 6.4% decline. So again, feeding into that better than feared narrative there.
Yeah, it's interesting, especially the assortment. They call it the wow assortment that they're trying to curate here. And ultimately, for a lot of the consumers that we're focusing in on, we've seen two trends really emerge over the course of this earnings season with regard to retail. One of them has been the off-price retailers doing successfully, doing well. However, it's interesting, the space that Five Below plays in, where we were talking about Dollar General and some of the headwinds that they're going to be tracking in the near term on the low-end consumer cohort and the challenges and the pressures that they're seeing. Five Below has a lot of overlap in that Venn diagram with Dollar General here. So all that considered, it'll be interesting to see what more the company has to say about their own outlook, especially if we do see even more outsized pressure on that end of the consumer spectrum.
Yeah.
Also here, let's talk a little Big Lots. Tumbling this morning, the off-price retailer may be filing for bankruptcy after years of sales declines, according to a Bloomberg report. Take a look at shares down 32% here. Now, as they are potentially considering bankruptcy here, according to reports, it was really kind of evident through one of the filings that had to go forward and kind of disclose to investors some of the retention bonuses that Big Lots had put out there to 4 executives, which ultimately amounted to about $5.2 million. You typically see that taking place when a company is trying to retain some of those executives to navigate through what is a very uncertain period, in this case, potential bankruptcy.
Yeah, a very uncertain period. And again, I just go back to the competition aspect of it all. And I feel like when you have something like a Walmart out there and available to consumers, this one-stop shop environment, it's hard for some of these other discount retailers to compete here. Coming up, we have breaking housing data at the top of the 10 a.m. hour. We'll give you the latest pending home sales numbers. Plus, we're talking to the CEO of cloud computing company Nutanix later in the hour. All that and more coming up on Catalyst.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Catalyst, everyone. I'm Brad Smith. Alongside Alexandra Canal, we are 30 minutes into the trading day. We're watching three catalysts today: the investor reaction to Nvidia's results, a possible rotation out of tech, and consumer spending.
First, great is no longer good enough for Nvidia investors, the company topping estimates and raising guidance once again. But were expectations just too high of a hurdle for the company to climb? We'll dive into that next.
And Nvidia seems to be the only one feeling the pain right now. Stocks are higher after fresh data showed the economy grew at a faster pace than expected in the second quarter. But with Nvidia under pressure, can the rally hold, or will investors rotate out of tech names and into value plays?
Plus, the consumer is still spending, but they are being more choosy, and some retailers are taking a hit because of it. We'll dive into what the health of the consumer means for the economy and the markets.
But first, we have some breaking pending home sales. Pending home sales falling 5.5% month over month, and economists were expecting a 0.2% rise for the month here. Some additional data here and color on this. According to the NAR, the National Association of Realtors chief economist Lawrence Yoon, good friend of the show here, sales recovery did not occur in midsummer. The positive impact of job growth and higher inventory could not overcome affordability challenges, and some degree of wait and see related to the upcoming U.S. presidential election here. Some additional just context on this as we think about where the regions were really operating here. All four regions of the U.S. posted monthly losses in transactions year over year. The Northeast actually rose, while the Midwest, the South, and the West registered declines in this most recent reading here.
Yeah, and a lot of potential home buyers here clearly waiting to see what the Federal Reserve is going to do when it comes to interest rates. There is a cut that is expected to come in September. We could see increased cutting throughout the end of the year. Obviously, whatever the Fed does with interest rates, that's going to flow through mortgage rates and impact some of this home buying activity. Also, the inventory levels, that's something that we've consistently heard from experts, that inventory, the supply has just been very tight right now, especially with those home buyers that were locked into those ultra low interest rates. They don't want to go anywhere at this point. So just something that we're going to have to continue to track to see if we can eventually see a rebound in housing.
Absolutely. Turning now to the big story of the day here. Nvidia, the stock still under pressure, reversing some of those earlier losses, but is this just a blip for Nvidia, or are there cracks showing in the AI space here? Here's what we've heard from analysts so far on this report.
These are very good results for Nvidia, and they're very good results for the cottage industry that has developed around data center construction. What it's not that good of a news for is the rest of the technology complex. AI has taken the oxygen out of the room for a lot of software companies.
NVIDIA had a great report. The valuation is stretched. We do believe we will see NVIDIA trade lower, and we plan to pounce. So I would say buy up. Our message has always been buy on the dips, and that continues to be my message.
For more, we have Andrew Chang. He is the technology director at S&P Global Ratings here. Andrew, you heard what some analysts are already saying in reaction to this report. We heard from company executives on the call last night. Want to get your read through.
Yeah, at S&P, we felt that this was a very strong second quarter. It met and exceeded our expectations, especially the data center compute revenue, which is essentially GPUs. Up 162% year over year, so massive growth there. But I guess it fell a bit short on the third quarter guide. 32.5 billion is strong, but I think the street whisper numbers were more north of 33, perhaps even 34 billion. So a bit shy on that front. At the same time, what I was most focused on was the Blackwell progress. And that was the main concern going into earnings. And I think Jensen put that to rest. Blackwell is sampling now, started volume production, shipping in the fourth quarter. We'll have billions of revenues this fiscal year, all positive sign. Meanwhile, Hopper demand is still very strong. So the so-called delay in Blackwell, I think, sets up the company nicely, frankly, for calendar 25.
And Andrew, you have a AA negative credit rating on Nvidia. For those not familiar with the definitions of these credit ratings, what does that mean and why did you assign that one to Nvidia?
Sure. First of all, the credit rating is AA minus with a stable outlook. We upgraded the company back in April. And to put it plainly, Nvidia is the highest rated semiconductor company globally, along with TSMC in Taiwan and Samsung Electronics in Korea. So the highest rating from the semi perspective. We really like the tech lead that the company has and the strong product execution thus far. And we view Nvidia, unlike other semi companies, as a platform company, meaning it's not only a GPU company, but it has a full rack scale solution along with software, which no one has. And frankly, AMD's acquisition or announced acquisition last week speaks to this unique strategy that Nvidia has fostered and frankly has dominated over the past 5 years or so. So from a credit perspective, high profitability, high cash flow, really strong balance sheet.
We continue to hear from tech execs that there's a far greater risk of underinvesting in AI right now. But at what point, if we didn't see the return on these investments actually come to fruition, would it start to impact some of their credit ratings, knowing that there's so much money that would have been going towards these expenditures and out the door, essentially, to bring this to life?
Yeah, I think that's the main risk from the credit perspective, which is the potential for short-term swings in demand despite the long-term massive growth potential. So this is not going to be an up and to the right every quarter. Hyperscalers, as you mentioned, they can't spend fast enough. But if the ROI on their investments aren't up to par, you could easily see Amazon's and Microsoft's pausing purchases for multiple quarters. They've done that before with general servers, so they can clearly do that with AI servers. And when that day comes, numbers will be, I can't predict when. It's not for at least a couple of quarters, but over the next, let's say, calendar 25, I could see a scenario where the hyperscale spending declines meaningfully, and that could cause some panic among investors. But we have to remember that this is a long-term growth story, that we should not be so fixated on short-term swings.
Okay, so it's possible to see that deceleration of growth, at least from the hyperscaler spending on these products in 2025. I know you said it could come in the next few quarters there, but will there be signs that investors can look for that is approaching?
Yeah, the easiest sign you can look for is obviously all the commentaries from Amazon, Google, Microsoft, et cetera. And the commentaries have been nothing but strong. They're collectively, from a hyperscaler capex perspective, probably growing 50, 60% in calendar 24. We don't have a good read on what that will be in 25, but we're fairly certain that'll be growing next year. I would say growing 10%, 15% is a good likely scenario and probably priced into the market. If you start seeing commentaries regarding, hey, we're starting to slow down, or our capex spend next quarter will be flat versus the prior quarter, that should be sort of a signal to investors that yes, Microsoft is now concerned about the return on investment on all these AI servers.
You mentioned at the top of our discussion here that Nvidia has one of, if not the strongest credit rating among some of the AI and tech companies on the street right now. Where are you hearing companies talk about AI, though, and saying, okay, they may be talking about it, but their credit rating doesn't suggest that they're actually in good standing enough to be able to pull off some of these massive investments?
Yeah, I would say the overall software sector, which I know has underperformed this year, are talking about AI, but we're not seeing tangible revenues yet, perhaps with the exception of, let's say, Microsoft or ServiceNow. But there are many companies out there, Adobe, Salesforce. These companies, again, software spending has been somewhat of a lagging lagging behind hardware spending. But our view is that the AI hardware spending will, over time, translate into better spending on the software side and also on the IT services side. So ratings impact for software has been limited thus far, but I could see maybe 2 to 4 quarters from now where software spending does pick up on the AI side.
Andrew Chang, the technology director at S&P Global Ratings. Thank you so much for your time today.
Great, thank you.
The Department of Labor is out with new initial jobless claims this morning, showing a seasonally adjusted 231,000 new applications for the week ending August 24th. That's down slightly from the 233,000 claims the week before. Meantime, employers added 818,000 fewer jobs in the 12 months ending March 2024 than were originally reported. So how much stock should investors put into these numbers as a catalyst for future Fed rate decisions? Here to discuss is David Miller. He is Catalyst Fund's co-founder, chief investment officer, and senior portfolio manager. Lots of catalysts going on in this show, very appropriate for today. But you just heard it there. We see jobless claims coming in roughly flat, upward revisions to GDP. How can you trust this data at this point?
Well, I guess that revision that we had in the BLS data, taking the number down by 800,000 in new jobs created, really implies that you can't trust the data to some extent, although I think some of those revisions were more based on undocumented immigration and jobs surrounding those that are hard to get to, what is the real number for new jobs created. So I think they're reasonably accurate. I think that revision was kind of overstated relative to the reality, but we're in a pretty healthy economy.
So you mentioned something key, and this came up in our last hour as well. How much is supply actually skewing the unemployment rate at this juncture because of immigration, because more citizens coming into the U.S. and adding to the broader kind of labor force possible participation rate?
It's a good question. So, look, you're definitely adding to the supply, but there was always plenty of demand, especially for lower income labor, which, a lot of Americans who've been here for a long time aren't willing to do for lower rates. So I think it's pretty healthy for the economy. I think it's contributing to GDP growth. I think it's helping, with this GDP print that we saw today. So I think you're seeing kind of more of a balancing effect. There was really a need for that incremental labor.
And you just said the economy is in a pretty healthy state, but you do see weak GDP growth in the fourth quarter, between 1 to 1.5%. What's the main driver behind that weak forecast, and how do you see that playing out into 2025?
Sure. So, I think it's just the lagging effects of higher interest rates and, those higher borrowing costs for companies. I think when you see rates start to come down, the Fed's expected to cut in September. There'll probably be another cut after that. I think you can probably get back to 2-3%. Type of GDP growth thereafter. And I think we can see more of a matching effect between what the Fed was hoping for, 2% type inflation combined with, 2 to 3% GDP growth.
What does your portfolio playbook look like going into the Fed's cutting cycle?
Sure. So if you look at where we're positioned now, we're long bonds. We're also long equities. Both of those should benefit from the cutting cycle. We're playing calendar spreads when it comes to commodities. So we're not betting on the direction of commodity prices, but we're trying to earn the storage costs associated with those. And then we're also trying to pick up the differentials between yields in different countries. So, if you can borrow in Switzerland or Japan close to 0 and lend in the US or Australia close to 5, those can be pretty good trades as well. So we're trying to play it as diversified as we can as to, where we're picking up our return streams.
And speaking of the Fed's easing cycle, you said in your notes here that a big question for the Fed is not whether they'll cut interest rates by 25 basis points or 50 basis points, but what the path and actions will be after that. Are you referring to the pace of cuts, and what's your base case there?
Sure. So, well, I think they're going to cut in September. That's almost a given. They're probably going to cut at least one more time after that. It's much more data dependent as to whether they'll keep cutting after those first two cuts. But I think those first two are kind of in the bag, and then we'll probably be in a bit of an equilibrium thereafter. Rates won't be higher for longer, but they'll still be a little bit higher. They're not going back to ZIRP anytime soon.
And so with that in mind, some of the top sectors that are really catching your attention right now, we know that technology, when easy as money or money policies become a little bit easier, technology stands to benefit. What are some of the other areas of the market that might catch your attention at this juncture?
So I just really like all of the really high margin, monopolistic type businesses that have really strong tailwinds. So obviously, technology is a great example of that. You look at these companies like Microsoft and Google and Nvidia. And
companies that don't want to be
money.
called monopolies, by the way.
Right. The companies that don't want to be called monopolies, but are, whether well, I'm sure they like it. They just don't want to be called monopolies. Yeah. But then, you look at the Visas and MasterCards of the world. If you combine inflation with more money coming through the system, combined with, taking a little cut off the top of every transaction, those are phenomenal businesses as well. If you look at media companies, you certainly also see some inflation in ad rates, and that can flow nicely down to the bottom line. I think it's just tough for these companies that are in more cyclical commodity type businesses. But any of these companies that have EBIT margins of 30% plus and natural growth, those types of numbers compound really nicely over the long run.
And we have an election coming up in November. Any election risks to the market that investors should be aware of?
Sure. Well, I mean, you have the one really big one, which is, what are they going to do with corporate tax rates? And, Trump's made it pretty clear he wants to keep the tax cuts that he's made, when he was in office. And the Dems have made it pretty clear that they want to go back to higher taxes. And then you have some things that the Dems have talked about, but I think are a little bit more political than things that are likely to pass, like, God forbid if they had a tax on unearned capital gains, or unrealized capital gains. I mean, that would certainly be catastrophic to the market, but I don't think anything like that would actually pass, even if they would, carry that as a policy on their agenda.
And of course, it comes down to what the makeup in Congress looks like as well here.
Certainly.
Because the markets certainly do love a little bit of logjam in DC. David, thanks so much for taking the time here with us.
Thank you.
David Miller, Catalyst Funds co-founder, chief investment officer, and senior portfolio manager. Hey everyone, coming up, we've got much more of your markets action straight ahead. Stay tuned. You're watching Catalyst. More retail names are out this morning, giving us an inside look at the state of the consumer here. Dollar General and Birkenstock moving lower, both citing a discerning consumer who is being more selective with their purchases, while Best Buy has investors optimistic that it reached a point of stabilization. Here with more, we've got Yahoo Finance's Brooke DePalma. Hey, Brooke.
Hey, good morning to you both. This continues to be a story of a very choosy consumer, one that's really looking to buy somewhere and then not somewhere else. And to kick things off, we saw that with Dollar General. What we saw in their report is a core customer who feels financially constrained. We saw positive traffic trends overall at Dollar General, but that was partially offset by negative ticket. We're seeing consumers there flock to groceries, but they're not necessarily spending on bigger ticket items like home, seasonal, and apparel. They actually lowered their fiscal 2024 outlook. Same-store sales there are expected to grow between 1 to 1.6%, down from the previously expected range of 2 to 2.7. And moving along to a specialty, consumer-facing company, Birkenstock. You have that shoe company saying that the demand is there, but consumers are being increasingly selective and more intentional with their spending. And with that demand here in the Americas, they call it, they did see growth decelerate to up 15%, but that's down from the previous quarter when growth was up 21%. And moving along to Best Buy, this has been a attempt at a turnaround story here. Investors are excited about that stabilization. They did see their slightest same-store sales decline since Q4 of 2022. Same-store sales were down 2.3%. And what they're seeing there is a consumer who's value-oriented and innovation replacement-oriented. That's what CEO Corey Barry said on the call. They now expect their earnings outlook to come in between $6.10 to $6.35. That's higher from their previous guidance, and they do anticipate that better than expected profitability to really boost in the back half of the year. But something to watch out here for, as consumers look to replace the goods that they got during the pandemic, AI will play a part in that. They're really thinking about, okay, do I want to wait for the next AI item to come into concept to really replace? And so when Yahoo Finance spoke to the CEO this morning, she said that the actual Copilot Plus, that new concept, came out during the quarter, so it was a relatively small percent of a lift. But as these new AI technology comes on board, it will then create a halo effect. You'll see price points sort of play out. Maybe people won't flock to the newest, highest cost item, but maybe they'll go to that second tier item that has that technology, but not as high as the new one, perhaps.
So AI potential tailwind for Best Buy, but really you just laid out a very mixed picture here, right? So for you, you've been covering the space closely. What's the takeaway here as we wrap up earnings season about, we keep saying the state of the consumer. I mean, is it just a bifurcated environment that we're dealing with? What's the takeaway for you?
Yeah, I think we continue to chat about this as you see a consumer going to Walmart, but then again, investors wanted more from Abercrombie and Fitch. And so it's a consumer who's being very discerning with their dollars, being really choosy, and now really looking for value. You saw Target cut prices on those household item goods that tended to work. You see consumers still focus on grocery, but also willing to splurge if they think that the cost is worth it on maybe that specialty item good. And so it'll be interesting to see how this plays out, of course, if interest rates come down, if mortgage rates change. We heard from Best Buy that appliances continues to do poorly for them, but should the whole housing market improve, then that could be a potential boost for them.
We'll see how the consumer can hold up through the end of the year. Brooke DePalma, thank you so much for that breakdown. And in legal news, Yelp has filed an antitrust lawsuit against search engine giant Google, claiming the company has a monopoly on local search and local search ads. This coming just weeks after a federal judge ruled Google violated antitrust laws and monopolized the search market. So the timing here, I think, is what stands out here, especially for a company like Yelp that is now willing to speak up, willing to fight back against a big giant like Google. And what they say are anti-competitive practices. It's this David David versus Goliath situation. And it's something that I feel like we've been seeing more of recently, even in different industries. I think back to Fubo TV and how it's fighting against Venue Sports, which is that joint sports venture between Disney, Warner Brothers Discovery, and Fox. A judge there granting a preliminary injunction delaying the rollout of that service. So it seems like we're in this environment, and we'll see what happens with the election coming up too, where antitrust is just being looked at again more closely.
Yeah, for Yelp's case here, I mean, they're trying to make sure that, number one, at the top of this, they're looking for more consumer choice, fair competition, more helpful Google search experience. And in this filing of the antitrust lawsuit, their case is essentially about this walled garden that Google has created and trying to keep consumers into, saying that they abused the monopoly in general search to dominate local search here and being the dominant gatekeeper in that, they allege, in general search with approximately 90% share of the market here. And one of the things that they call out within this filing as well is actually FTC economist findings. 32% of Google's so-called reviews are not actually reviews at all and really just consist of star ratings with no text, knowing that users find reviews without text to be less helpful. Google burying those ratings below its text reviews for a given business, yet still includes them in the overall review count to inflate the credibility with consumers looking for trustworthy ratings here. And so that is the entire business for Yelp, essentially, add in some photos and some pictures here and there.
I do like the photos.
I mean, look, if the food does not look good, I'm not going to go there.
Oh, yeah. I'm a big photo girl.
I need the photo with the stars and the text for reviews for myself. Full picture here. Also, our final trending ticker here that we're tracking on the day. Payment network Affirm surging after crushing Wall Street estimates here. CEO Max Levchin calling it a killer quarter, announcing an expected top-line growth of 33% for fiscal 2025 and a leadership change with Michael Linford becoming Chief Operating Officer, plus Rob O'Hare joining as CFO. We've had an opportunity to speak with all of those execs here, so we'll see what more the company can prove to Wall Street within the broader outlook that they've provided post-earnings here. Coming up, Nutanix shares soaring after its fourth quarter earnings. We dive into the report with the company's CEO. There you see him on the screen, Rajiv Ramaswamy, here on Catalyst next.
Shares of cloud computing company Nutanix are surging today, up about 19% as its fourth quarter earnings and full year guidance topped analyst expectations. Wall Street is responding with a slew of price target hikes. Raymond James, Barclays, Morgan Stanley, and more now seeing upside for Nutanix stock. We have Rajiv Ramaswamy, the CEO of Nutanix, on for more this morning. Rajiv, congratulations on the quarter. And the stock clearly doing well. Investors liking what they're seeing. You guys also reported your first full year of positive GAAP operating income. What do you credit for that?
Yeah, I mean, we had a strong finish to the year overall and the last quarter as well. Our ARR grew 22%. Our free cash flow generation was $598 million, which is almost 3 times last year. And overall, we hit a Rule of 40 score of 43. Now, the reasons for all of these are that fundamentally, we have a platform that is great for running critical applications for customers around the world. Companies are looking to us in a difficult macro environment for helping them reduce their TCO, enable them to transform themselves. And we feel good about the year here in terms of the progress we were able to achieve. The platform is great for large customers such as Wells Fargo, investing in our platform as a key partner and customer. We've made significant innovation in this, in terms of our platform, our modern applications, and generative AI. And more recently, significant go-to-market leverage through partners, big partners such as Cisco and more recently Dell. So all of this is contributing, helped us beat our guided estimates for the year and for the quarter, and also came in above consensus for our next full fiscal year guide.
What type of uptick have you seen in generative AI applications that are relying on Nutanix right now to make sure that they can continue to have solid user experience, or just putting into market what is expected of some of these applications very early days?
Yes, indeed, it is, as you said, Brad, very early days for companies actually using generative AI in production. And a lot of important things to be figured out. First, they need a simple platform to run this. They need to be able to run this in a secure way, maintain their IP, and also run it wherever their data is located. And data these days is located everywhere. Some of it in the public cloud, but a lot of sensitive enterprise data is sitting inside data centers and at their edges. And so we provide a platform that helps all of this run in a very simple way. Now, companies, I would say, are still in the early stages of deploying generative AI. They're looking at use cases such as document search and analysis, co-piloting for their developers, customer support, enhanced fraud detection. And what I will say is it's very broad-based. We see companies across financial services, healthcare, public sector, defense, all now thinking about how they can actually use generative AI in a secure, private way.
And partnerships a clear standout in your fiscal 2024 results. Nutanix signing new or enhanced agreements with Cisco, Nvidia, Dell. Can you explain the significance of those partnerships and how that ultimately helps customers?
Yeah. All of these are great market leaders, and we are thrilled to be able to partner with them. In terms of Cisco and Dell, both of them are actually taking our solutions to market. Cisco is reselling our product. They have been for most of the last year. Dell is our most recent addition. And they are also now in the market with our product. And as you can imagine, they have a huge presence in the industry in terms of their footprint, and they're a market leader. And it's great that they are now taking our products to market. It is a sign that we are truly the platform for companies to run their applications. And that's why we're seeing all these folks partner with us. And with NVIDIA specifically, it's around really making enterprise AI available for companies to use in a secure way.
Do you want Nutanix to be thought of as an AI company? What is the profile that you would like investors to have in their mind as they're figuring out exactly what that growth profile and trajectory that you've talked about on the call yesterday, what that really looks like going forward?
Yeah, I think the one-liner here would be that we want to be the leading platform for companies to run all their applications and manage their data anywhere. And if you look at that set of applications, perhaps the most modern of all applications there is generative AI. And so we want to be that platform for companies to run generative AI applications as well, but all applications in the enterprise.
And one of your prior competitors, VMware, recently purchased by Broadcom. Are you open to M&A opportunities either as a buyer or a seller? And do you expect in the software space at large we're going to see more M&A tick up?
Yeah, first of all, I think in terms of us acquiring companies, I mean, for us, technology tuck-ins, we do as a matter of course. We did some this last year as well. We acquired a company called D2iQ, which gave us the foundation for modern applications here. Now, in terms of us as a standalone company, as you can see here, we're doing pretty well in the market. and we continue to grow. We continue to be a key partner to some very large companies like Wells Fargo and others in the market. So we are on a great path in terms of an organic path and continue to drive growth, continue to drive sustainable, profitable growth, both on the top line durably and also continue to drive bottom line leverage. So we're in a pretty happy place right now as a company and continuing to focus on our customers, our products, and driving innovation.
I mean, multi-cloud infrastructure is not cheap, Rajiv. When you think about the deal cycle that you're seeing right now, some of the themes that we've heard over the course of this earnings season from other enterprise software or cloud companies has been elongated deal cycles or more deal scrutiny. What is that looking like for Nutanix right now?
Indeed, Brad, you hit the nail on the head there. We've been talking about this for the last several quarters. We have seen some elongation in the deal cycles, and that's partly because companies want to be more clear about what they're getting in return for their investments. And companies are not deprioritizing. In fact, they are prioritizing their technology investments. But what they're looking for is strong return on investment, and therefore the approval levels are further up in the food chain. And that's where we shine. I mean, once they deploy our platform and they replace legacy platforms, companies generally get a huge amount of total cost of ownership benefits. And that's what's playing out right now for us in the market.
It sounds like a lot more travel for you, Rajiv, to really make sure that you could seal the deal on some of these major partnerships here. We appreciate you taking some time here with us to discuss the earnings. As always, Rajiv Ramaswamy, CEO of Nutanix. Thanks.
Thank you, Brad and Ali.
Absolutely. Ali, I'll toss things on over to you.
Hey, Brad, we want to take a look at this day in history. On August 29th, 1997, Netflix was born. Reed Hastings and Mark Randolph founded the company after coming up with the idea to sell and rent DVDs online and mailing them to customers' homes while carpooling together to work. By September 1999, the company introduced the monthly subscription model, allowing them to charge a flat fee for unlimited rentals without due dates, late fees, shipping and handling fees, or per title rental fees. Then, as DVD sales exploded in the early 2000s, Netflix began to see massive growth, which spurred the company to go public. Netflix listed on the Nasdaq in September 2002 for just $15 a share. And after helping guide the company through the process, Mark Randolph, he stepped away, selling his shares in 2003. 4 years later, though, and 10 years after its initial inception, Netflix embarked on its streaming journey with just 1,000 titles. At the time, subscribers of the DVD rental business were able to stream for no extra cost. By 2010, the company completely pivoted strategy to focus on streaming. At the time, CEO Reed Hastings said 3 years ago, we were a DVD by mail company that offered some streaming. We are now a streaming company, which also offers DVD by mail. Netflix inked deals to stream films from Paramount, Lionsgate, MGM, and acquired the rights to massive hit shows like Breaking Bad. Soon after, it began to create original content with popular shows like House of Cards and Orange is the New Black. Since then, we've seen Netflix grow quarter after quarter, and today it has nearly 280 million global subscribers. It's growing its ad-supported streaming tier, and shares are currently hovering around all-time highs. If we look at the max chart for Netflix, the stock is up over 69,000% from that $15 share price in 2002. So if you invested $1,000 in Netflix in 2002 and just left it there, you'd have about $690,000 today. So happy birthday, Netflix. My couch is certainly happy that you were born. And, you know, I mean, Netflix is just one of those companies that we constantly talk about on this show. And we have seen a significant outperformance recently, especially as the company looks to further its presence in ad-supported along with live sports.
All right. Happy birthday, Netflix. Thanks so much, Ali. Appreciate it. Guys, coming up, Lululemon will report their earnings after the bell today. What should you expect to hear from the athletic gear brand with the wishbone? That is next. Now taking a look at shares of Lululemon, they're up right now by about 1.2%. The athletic wear company going to be reporting its Q2 earnings after the bell today. Investors are going to be looking for further guidance here as cautious consumers and more competition have led to shares falling almost 50% year to date. For more, let's welcome in Jim Duffy, good friend of the show. He's Stifel's Managing Director of Equity Research and Analyst for Sports and Lifestyle Brands. Jim, great to have you back on here. So let's tee it up here. For Lululemon, we've already been looking across the retail environment and trying to figure out what a more cost-conscious consumer and a consumer that's looking for value hacks will spell out for this company. What's your estimation? What's your anticipation here?
Yeah, hey, Brad. Thanks for having me back on the program. Super interesting quarter that Lululemon's about to report. As you mentioned, the stock down about 50% year to date. They've had a product which they had to pull from the shelves, a product line called Breeze Through, which creates a hole in the merchandising assortment. So we think it's broadly expected that there's going to be a reset to the outlook. We, however, want to buy the stock ahead of that. This is the best economic model in my coverage universe. We are believers in the global trend of greater concern for health, wellness, fitness, self-actualization. Lululemon uniquely positioned to lead that trend. The prevailing narrative here is that Lululemon is done growing in the U.S. market due to competition and some other factors, but we don't believe that's the case, and we think this is a good opportunity in shares.
So you're very bullish, it sounds like, on Lulu. Now, personally, I'm a customer. I have gone and I've purchased products from Lulu. However, I always note how expensive their brands are and how you can often find very similar types of clothing at other cheaper retailers out there. So when we talk about this cost-conscious consumer that Brad was just alluding to, is the pricing too high for Lulu? Is the competitive environment too great at this point? What are the biggest risks in your view?
Well, first off, I'm glad to hear you're a customer, Alexandra. The pricing, that's been a concern on Lulu, and competition has been a concern on Lulu for as long as I've been following the stock. The key for Lulu and the key to their success is innovation and the quality of the product, which distinguishes it from alternatives in the marketplace. And we believe they still have that. What we see from consumers is a willingness to pay up for quality, a willingness to pay up for innovation, and a willingness to pay up for newness. And where Lulu may be lacking some now is on the newness front, but that's a fixable problem. We expect they can address that in the merchandise assortment in coming quarters.
It's really interesting. That's come up for a few different brands here, not just for Lululemon. Newness is what I'm talking about here. That's come up for one of their biggest competitors as well, Nike. They came out with their earnings, and of course, we've been tracking that. Stifel recently released their back-to-school sneaker survey. What can you tell us about Nike's market share in that department here, as we're going to be tracking Lululemon up against what we'd already heard earlier and kind of precursor to the earnings season, if you will, from Nike?
Yes. Last week, my team and I conducted the Stifel annual back-to-school survey. We have over 20 years of data tracking trends between different product categories and different brands. And the good news is that the marketplace is generally healthy. There's a lot of newness in the assortment that consumers are responding to. Our checks are showing traffic healthy and inventory balances at retail healthy. The bad news for Nike, however, is there are some other brands that are bringing newness and getting momentum. Nike's share of popularity fell from 88% last year to 61% this year. So quite a steep decline on a year-to-year basis. They are, of course, still the most popular brand in the assortment, but we saw strong gains from New Balance and also strong gains from Adidas. For New Balance, their 16% of most popular shoe references is the highest that that brand has ever registered.
And Jim, you currently have a hold rating on Nike, but you did lower your price target to $79 a share, below where shares are currently trading. What's the pivot here for Nike to regain that dominance?
Yeah, it's a great question. The reason for adjusting the price target lower was based on these checks and the momentum we're seeing from competitors. We think a turnaround is going to take longer to execute than is currently reflected in the consensus estimates. The path to recovery here Newness has to play an important role in that. What has made Nike great for years is innovating and designing exciting new product and then having compelling marketing that gets consumers excited to engage with that product. And we think they've hit a bit of an air pocket in that execution in the near term.
All right, from sneakers here to clogs. That's what we're focused in on here as well. Here, closing out with Birkenstock. I mean, Allie, you've been tracking this one. You were talking about this one this morning.
Right, yeah, shares are down about 14% right now. So, Jim, their profits fell short of estimates last quarter. What can they do to get back on track? Is it new innovation? What's the go-forward strategy?
Sure. Well, I don't necessarily believe they're off track. The stock was priced for perfection. And expectations were high going into the quarter. Myself and others expected them to over-deliver on the quarter and raise the guidance. Indeed, they did over-deliver on the EBITDA line, but they did see some deceleration on a sequential basis relative to the fiscal second quarter. All indicators in the marketplace are that appetite for the product remains strong. Inventories in the marketplace are well managed. I think it's just a temporary setback in the stock.
So, all of these things considered, I mean, we've been talking a lot about everything from athleisure to what is a little bit and far more leisure in Birkenstock at least. Who is best positioned right now from your perspective, Jim, to navigate a very uncertain consumer environment, even as we get into the back half of the year where we've heard from Foot Locker that there could be some heavy promotional pressure that needs to come forward?
Yeah. We keep bringing up the subject of newness and innovation, but it's those brands that are really bringing compelling and exciting new product that's driving consumer engagement. As we think about the consumer macro backdrop, the consumer is becoming more discerning. We do think they still have good capacity to spend in discretionary categories. They're just being more selective about where they're allocating those dollars. Those companies like an On Running, like Birkenstock, that are bringing excitement to the marketplace, we think they can continue to drive growth.
Jim Duffy, who is Stifel's Managing Director, Equity Research Analyst for Sports and Lifestyle Brands. Thank you so much for joining us.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Catalysts.
We're taking a closer look at some trending stories on Yahoo Finance. First, we got to get to this one, starting with bad news for the messaging app Telegram. The company's CEO, Pavel Durov, is being charged in France. Prosecutors accusing him of enabling organized criminals to carry out unlawful transactions on the platform here. And we do know that this was issued Wednesday, just after, coming into custody by police there. But you got to remember the platform itself, Telegram, has been used because of its encryption, and that is actually, unfortunately, making it a little bit more of, especially internationally here, a use case for cybercrime, and that's where there has been more of the allegations that have led to these preliminary charges as well.
Yeah, Telegram did post a statement on the platform saying, in part, quote, "It is absurd to claim that a platform or its owner are responsible for abuse of that platform. Almost 1 billion users globally use Telegram as a means of communication and as a source of vital information." They're waiting for a prompt resolution of the situation. Meanwhile, French authorities noted almost total lack of response from Telegram to legal requests here. So I think when we think about the future of this company, this is definitely a significant overhang.
I mean, the moderation on the platform, minimal at best.
Yeah.
And even as you think about where the response is going to be from the company, of course, it's going to double down on what its platform is used for. But I think more broadly here, Europe, we've got to remember, has some of the strictest internet use laws in the world. I mean, of course, you could put and bring CCP back into conversation there. But all those things considered to be interesting, where these proceedings play out, how they play out, and if there's anything from a settlement all the way back to now a severe criminal charge for Durov as well. We'll see exactly what those proceedings look like.
Something we'll be watching closely here. Another story that we're keeping an eye on is OpenAI. It's reportedly in new talks for a new funding round that would value the company at $100 billion. That's according to the Wall Street Journal. Thrive Capital is reportedly planning to lead the round with $1 billion investment. And of course, Microsoft is expected to put more money in here. Now, Microsoft invested $10 billion into the startup in January 2023. It previously had invested $13 billion into the firm since 2019. Now we have Microsoft holding about a 49% stake in this company. So, this would be the largest injection of capital that OpenAI would see. And when you think about the valuation numbers here, the fact that we could be at over a $100 billion valuation for this company, that's a crazy number to wrap your mind around.
It's hectacorn status. We could be looking at the 5th hectacorn company. As of November 2023, there were really only 4: ByteDance, Ant Group, SpaceX, Shein. And so we were talking about what IPOs would look like for those names. We could potentially have a 5th hectacorn for those who are really interested in mythical creatures related to the stock market or just the broader business landscape as a whole here. So this $100 billion market, or actually the funding valuation, if they were to come public in any near term, which, I mean, they seem very well capitalized, doesn't seem like they'll need to go public, and they've already got some very great publicly traded companies that are involved within this funding over the years as well. Microsoft, of course, being one of the namesakes there.
And they were privately valued at around $86 billion, according to the journal. So significant jump up with this funding round.
100%. Well, Nvidia, we're also tracking that here today. Nvidia earnings have become like a Thursday night football game, with some investors throwing watch parties at bars here. And I mean, this is what's next. More people who want to know what to do with their money, perhaps watching. Yeah, tell your local bar to just fire up Yahoo Finance. Why not?
Yeah, they had CNBC, Bloomberg. They had all these different financial outlets out there. And people were chatting about their investment positions. There was this camaraderie when the earnings report dropped. It just speaks to the enthusiasm that the AI boom has really driven across the sector here. And I think this is something that we're going to see more and more of over the years.
Well, I mean, look, we better.
Yes.
Because, I mean, more Gen Z, millennials, we've got access to content at our fingertips, and everybody does out there. But as long as you're kind of consuming and taking in some of the video realm as well, I mean, you don't have to purchase a Sunday ticket to watch this. So, just tell them to throw on Yahoo Finance and we're good to go.
Throw on Yahoo Finance, forget NFL season. It's earnings season, baby. That's the new NFL.
But fly, Eagles, fly.
Fly, Eagles, fly. Yes. Yeah, Brad, fist pump there because we're both Eagles fans.
There we go.
Coming of Wealth is next. It's dedicated to your personal financial needs. Brad Smith, right over here, has you for the next hour. Stay tuned.
Wait, that's the end of Catalyst already?
Already.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, Nvidia earnings and how to play them. We'll talk about whether or not now is the time to buy now that the earnings report has officially been released after yesterday's close. And housing hurdles. Are high mortgage rates really the market's biggest problem? We address the question with an economist. Plus, tips for job seekers who might be fighting a little burnout. We'll talk to a LinkedIn career expert about the best things you can do to fight the right burnout or the right employer that you're seeing here. But first, Nvidia shares are still falling about 90 minutes into trading after its guidance disappointed Wall Street. So should investors buy the dip, or is there a reason to step back from the AI giant? We have Nancy Tengler here to kick off today's show. She is the CEO and Chief Investment Officer at Laffer Tengler Investments. Nancy, great to have you back here on the program with us. So first and foremost, I got to get what you make of the report that we saw from Nvidia. Shares moving lower by about 2.5% as of right now. They've been down throughout trade post-report, but it's not weighing on the markets that much, which is interesting considering the outsized move that we've seen driven by Nvidia. What do you make of this?
Yeah, Brad, thanks so much for having me. Well, I think what you're seeing is that the other AI proxies like Broadcom and AMD, and then some, expanded out from there, are doing well on the report. I think the issue is that the stock had run off the recent lows pretty hard. It's not super expensive when you look at it on estimated sales or estimated price to earnings ratios, even the PEG ratio. But it was set up for a disappointment on the Blackwell yield problem. I think the company has right-sized that. I think you want to use weakness as an opportunity to own this stock for the next 5 to 10 years.
Interesting. And so we've heard of valuations perhaps in the future, over the next 5 to 10 years, getting as high as maybe $10 trillion for this company. Where do you believe that there's going to be perhaps the next big thrust of energy around Nvidia, or is this going to be in kind of wait and see mode and ultimately watching the company deliver upon what the market expects of it?
Well, it's interesting. If you look at the decelerating growth that analysts also seem to be worried about, and you go back and compare that to Microsoft's 90% growth in the cloud and then subsequent slowdown. I mean, we know that these levels of growth are not necessarily sustainable. And so I think what you want to do as an investor, but by the way, that did not hurt Microsoft's stock price. It's up 3 to 4 times from that decelerating cloud growth. As the use cases for AI go up, and they are, all you have to do is look at a company like Walmart, whose margins expanded last quarter without raising prices, and we believe that was largely due to their implementation of AI across the platform. So in advertising, e-commerce, stocking, cataloging products. This is what we need to see next. And I think we are seeing it broaden out by industry, and that will be the next catalyst for growth. So I think we're in early innings. We've drawn an analogy to the 1990s for the last couple of years. I was managing money then. This is not the internet bubble. This is not eyeballs being measured. This is real technology that will drive productivity-driven growth. And I think we saw that with the GDP numbers coming up in productivity in the almost close to 3%. So you just have to kind of steel your nerves and ignore the volatility.
And so for Nvidia, down today while the markets are higher, AMD, I'm taking a look at our Wi-Fi Interactive. AMD is actually up by about 1.25% right now. I mean, we didn't think we'd have a day where Nvidia was lower, but the market's still holding on to gains. So you're also keeping tabs on some of these other chip stocks to see where there might be opportunities. Where are you sensing those opportunities?
Well, so we added we added AMD to our portfolio in the last quarter on the sell-off. This company needs 1% growth, market share growth in GPUs to increase revenues by $1 billion. So they can take the crumbs and still do well. And one of the things that I find fascinating is that Lisa Su and Jensen Huang are sort of distant cousins. And so he recently said, we're family, we buy from family. So I think AMD is in a good, solid number 2 spot, and we expect to see that continue. We love the transaction they just announced with ZT Systems. So, and they're sort of taking a page out of the Nvidia playbook. We've been long-term owners of Broadcom. We've actually had to trim it back. We were buying it when the yield was 4%. It's now about 1.5% due to price outperformance. We still like the name. We think it is a place you want to be exposed to, but do not underestimate the growth in generative AI. I think there's a lot of naysayers coming out, and we're seeing the use cases expand pretty dramatically.
Nancy Tengler, who is the CEO and Chief Investment Officer over at Laffer Tengler Investments. Great to have you here on the program. Appreciate it, Nancy.
Thanks so much, Brad.
Certainly. Let's turn now to the housing market here. Pending home sales, a forward-looking indicator of sales based on contract signings, they fell 5.5% in July, a big drop from the 0.2% gain that economists were expecting. Now, the pending home sales index slipped to its lowest reading on record here. The National Association of Realtors chief economist Lawrence Yun writing in a statement that a midsummer sales recovery did not occur, and job growth and high inventory could not overcome the affordability challenges here. So here with more, we've got Brad Case, chief economist at Middleburg Communities. Brad, what happened here? We were expecting growth, fractional percentage as it may have been. This is a far cry from what we were anticipating.
Well, the reason that we expect growth is that there's been such strong growth in demand for housing, and that comes from people forming new households. The problem with the owner-occupied market, which is what this morning's report was about, is that houses are simply too expensive. It's really, really difficult for somebody to justify putting out that kind of money for an asset whose price really can't be expected to perform very well going forward, given how much you're paying for it right now. It's just like buying a stock, at too high a price. So I think, people talk a lot about how mortgage interest rates, when they come down, will help drive more house purchases, and that's true. There's been a lot of optimism that maybe that would start in late September. I think it's much more likely to start in November. But that doesn't really get at the fundamental problem, which is simply that house prices are too high. And buyers are leery about buying an asset that may not perform well in value.
It looks like year over year, pending transactions were also down 8.5% here. So what do you need to see? What do you believe we need to see on the mortgage rate front in order for transactions, in order for some of the purchases to fully come over the goal line?
Well, over the next year and a half or so, I would expect to see policy interest rates come down by 1.5%, 2%, maybe 2.5%, and that will certainly help mortgage interest rates come down. But that's not really going to solve the problem. The problem can only really be solved by building more housing, not just owner-occupied, but housing in general, because, as I said, the fundamental issue is the fact that there are too many people who want housing. They are tired of living with their roommates from college or whatever. They're tired of living in their parents' basement. They want their own place, whether it's to rent or to own. And the owner-occupied housing is simply too expensive for them right now.
You know, it's really interesting, Brad, because there's a note within here from the NAR chief economist, Lawrence Yun, who we've had on the program several times before. And he said that there's some degree of wait and see with regard to the upcoming U.S. presidential election. That is synonymous with what we've heard from Redfin and some of their own surveys and studies as well here. What type of net impact do you believe that there could be both pre-election and then post-election if we do see people waiting for some of the purchasing activity until we get through the general election in November?
I don't really believe that people are waiting and seeing what's happening in the general election. I think if it to the extent that it does affect the housing market situation, it may be because the new administration, whichever it is, starts to break down some of the barriers to new supply in the housing market. But again, I don't see interest rates as the major barrier there. So I think that the wait and see is much more about sort of uncertainty about whether it's really a good idea to buy a house. You may know that generally speaking, people are better off, instead of buying a house, taking the money that they would have put down as a down payment and putting it into the stock market instead. And so there are a lot of people, I suspect, who are concerned about house prices and thinking, well, maybe my investment is better in the stock market than in my house.
One of my favorite and unfortunate stats that I need to track is and relating more to weather. And I bring this up, and go with me here. I bring this up because this also impacts where people are migrating to or purchasing new homes as well. And 2024 in progress, according to the National Oceanic and Atmospheric Administration here, there have been 19 confirmed weather or climate disaster events with losses exceeding the $1 billion mark to affect the United States. Last year, we saw a record with regard to that. Is there any kind of changing in mindset more broadly that you're tracking or seeing as a result of some of these billion-dollar disasters that are taking place that are impacting home buyer mindsets as well?
Yeah, there's no question that people are revealing that they would rather live in a place where housing costs are lower and the weather is more moderate, and that's the Sun Belt. For my company, that means the Southeast and the Mid-Atlantic. Other companies focus on sort of the western part of the country. But as you say, weather is an issue. Weather is really an issue in coastal markets. So, for example, for my own company's activities, generally speaking, we're not building on the coast. We may be building in coastal markets, but we're building away from the coast itself. And so I think that is what we're likely to see. People continuing to move to the Sun Belt, to the Southeast, the Mid-Atlantic, the Southwest, but not to the oceanside areas there. The people who are going to continue to move to actually the coast itself are going to be very wealthy people who don't need to worry about the disasters. The people who do need to worry about weather disasters, they're going to move to more inland locations within those markets.
Brad Case, Chief Economist at Middleburg Communities. Brad, it's always a pleasure to grab some time with you and get your read through on the housing market. Appreciate it.
Thank you very much, Brad.
Certainly. Well, most people are cutting back their spending according to a TD report. We'll break down the report and how you can maximize your returns while spending. That's right after the break. Stick with us. Consumer confidence hitting a 6-month high in August. Despite confidence rising, nearly 1/3 of people have been cutting back on their spending due to concerns about the economy, according to a TD Bank survey. To break down how you should be spending, we've got Chris Fred, TD Bank head of U.S. credit cards and unsecured lending. Great to have you here, and thanks so much for hopping on the program with us, Chris. First, let's just start on your read-through of the consumer right now, because it seems like if we're seeing a consumer that's tapping or swiping credit cards more often, that just means that they're more hesitant to deploy cash in the event that they need that in an emergency situation here. What is your read-through?
Yeah, I mean, first of all, thank you for having me on your program, Brad. Despite the fact it seems like you're an Eagle fan from the prior segment, but The survey, definitely revealed a lot of anxiousness on the part of the consumer and their financial situation. About 2/3 of customers or consumers are stating that their finances are keeping them up at night. About 1/3 of them, also saying that they're cutting back on spending. So definitely, higher prices, student loans, higher borrowing costs, definitely weighing on the consumer right now. But I think what's interesting is, despite that, we're also seeing consumers feel like they actually have the ability and the confidence to manage their finances. It's just a lot of work. It creates, it necessitates a fair amount of grit and work to be able to manage your cash flow and your finances. And so, definitely see this weighing on consumers. But the Americans continue to be quite resilient, but it's a lot of work. And it's a lot of anxiety, and that's really coming through in what we're seeing right now.
So we're also seeing credit cards dominate how people pay, as we were talking about. Can you tell us about how people should be navigating that and some of your top tips?
Yeah, I mean, we definitely see credit cards as well as debit, really trumping, cash. I think about 10% prefer to use to cash to do their spending. So credit cards obviously are playing a more and more important role. But largely what we saw in the survey was really around convenience, the ability to earn rewards, and those things being much more important than necessarily just trying to hold on to cash for that uncertainty. We do see payment rates going down, but not dramatically, and really not even lower than what we saw pre-pandemic. So, definitely seeing customers, have a willingness and a confidence to use those credit cards. But cash continues to become a smaller and smaller part of people's wallets.
What are some of the smart spending habits that people can put into place, even as they're identifying what their cost basis is, where they need to spend, versus some of those discretionary items that they want to spend on, but perhaps we need to ball in a budget a little bit more?
Yeah, what's important is, I think I heard you say this earlier in one of your segments is, there's more information and more tools than's ever been available before. Consumers are so much more smarter about their finances. Households are talking about finances. I know, my relatives are constantly asking me questions about their credit score and things of that nature. I think what's most important is that people need to understand where they're spending. And knowledge really is power. When you think about how you're spending, where you're spending, if you don't necessarily know what those are, it's really hard to build a budget. It's really hard to understand how that relates to your income stream and things of that nature. So there's so many tools out there for you to go after. You can do a simple search in terms of spend trackers, excuse me, and that would reveal a lot about how you're spending. But I think what you'll see when you do that is that there are a lot of expenditures that all of us have, whether it's subscriptions and you didn't realize you were paying for, the coffees and whatnot that we all need for simple pleasures. But can you cut back on that a little bit? Can really make a big difference when you do this on a daily basis, when you do it on a monthly basis. It adds up. But you kind of need to know that. Yeah. And I think these tools are really important to getting you there.
All right. Chris, Fred, some of my simple pleasures are simply just watching the Eagles. TD Bank head of
Good luck with Saquon.
Appreciate it. TD Bank head of U.S. credit cards and unsecured lending. Appreciate the time, Chris.
Appreciate it.
Well, coming up, feeling burned out or in search for a new job, a LinkedIn career expert has some tips for you when we come back. It can be very frustrating to try and find a new job, from writing endless cover letters to feeling like you're being ghosted by hiring managers or recruiters. It can be easy to feel burned out by the entire process. Here to help out with some tips on how to get past those feelings and get you one step closer to your dream job is Andrew McCaskill. We've got LinkedIn career expert here with us back on the program. Andrew, great to see you here. Now, there can be burnout on both sides of this, both looking for a job, you can have burnout in your existing job. How and what are the ways to really identify or acknowledge what burnout looks like and how you can get on the other side of that as well?
Yeah, I mean, listen, the job market is competitive and opportunities are becoming so much harder to find. And active job seekers are really feeling it. When we took a look at workers' confidence in their careers, that confidence in their career and their career progression dropped to a new low this summer. And professionals are feeling it. It shows up in feeling like their confidence is down. They feel stuck. Many of them feel burnt out. And my advice for folks, if you're feeling burnt out in your current job, right, is one, you got to take a little bit of control. Start to take breaks. A lot of the things that we talk to people about during the pandemic are things that you should be doing now if you're feeling that burnout. And then take control. You take control of your day. Set an agenda. Be intentional about your meetings. Really be prepared for those meetings so you feel like that you're happening to your day and your day isn't happening to you. Finally, if you're feeling burnt out right now, holler if it hurts. Start to talk to your manager about how you can sort of reprioritize work. Maybe think about a stretch assignment if that will sort of shake up your day, or to get your manager to help you reprioritize things. Here's the deal though. Don't go to your manager with just a problem. Go to them with some possible solutions too, and then you have a better conversation.
Say you're trying to navigate and really put forth a career pivot as well. How can you effectively pull that off, knowing that that's taking you from one skill set or job function into another, and how can you kind of daisy chain that, especially knowing that some people can't or don't leave a job until they have that next one lined up?
Yeah, I mean, we talked to hiring managers to see why so many of these job seekers and job candidates were feeling like they were getting ghosted or feeling like they weren't getting calls back. And so hiring managers said the number one reason why they were not interviewing candidates is because their skills did not match up. They didn't have the right skills for the role. And so for people, if you're looking for a job right now, it's a highly competitive market. You've got to showcase your skills, especially in a role that may be in a different industry, and really be explicit about how your skills will match up. And you may have skills that will transfer from one industry to the other one, but you've got to make the case for that. You've got to be prepared to tell your story. Your job is to look at that job description, and for everything that's on there, to go back to your experience and say, here's how I would match up the skills that I have to do a good job here for this.
All right, say you do get the interview. What are the tips to nail the interview here, Andrew?
Here's the deal. The other thing that the hiring manager said to us is that the number two reason why people were not getting calls back is that they weren't being responsive. You've got to be responsive. You've got to respond back to that recruiter or that hiring manager. And proofread everything. The details matter now more than ever. You've got to respond in about 24 hours if you get a call back from a recruiter or a hiring manager. Proofread everything. The details really matter. And here's the other thing that may be a little controversial, but you've got to review your online and social media presence as well, just to be sure that you're putting your best foot forward. You can absolutely be authentic in your public online life, but you need to also understand that you are in a competitive job market. So how you show up on the internet needs to also be professional.
All right, Andrew McCaskill, LinkedIn career expert. Andrew, always great to catch some time with you and get some key tips for those job seekers out there and those currently in a position as well. Andrew, appreciate it. Thanks. Coming up, we've got another episode of Stocks in Translation. Yahoo Finance Markets and Data Editor Jared Blickreed sits down with market technician Trent Smalley. They talk hedging, the wild moves in the VIX, and capex spending, capital expenditures. That's next.
Welcome to Stocks in Translation. I'm Yahoo Finance's market and data editor, Jared Blickery, and I am joined by the people's voice. That would be Sydney Freed. And before we jump into the conversation, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, or wherever you get the podcast. Today, we are joined by Trent Smalley. He is a chartered market technician, a UFO enthusiast, and portfolio manager at JSPM LLC. Welcome, guys. Now, on the docket today, we are going to be talking about normalization. That's in terms of policy, interest rate, even inflation. Our phrase of the day is hedge. You can hedge your bets, you can hedge a fund. Many have tried, some have succeeded. And this episode brought to you by the number 199. That eye-watering sum is what Wall Street expects 5 of the world's largest tech spenders to shell out on AI this year alone. So Sid, Trent, markets are settling down from their close encounter of the VIX kind last week. We had the VIX trading in the mid-60s. It's now down to the 17 level. It has just crashed back to earth. What do you make of all this?
I was thinking, actually, just this morning, I was like, there has to be some record of, this might be the record, actually. In 1 week or 5 or 6 trading sessions, the VIX going from the 60 to 65 to 17 or 18, wherever we are
in one
now.
day. That one-day record was just amazing.
Okay, I thought it had to be close. Well, I think with the whole Japanese yen carry trade last week, the market obviously had a case of the summer yips. And it didn't help that, over the weekend, the news hit that Warren Buffett had sold a significant stake in a very large position in Apple. He still owns a ton of Apple. But I think that and, the whole Japanese yen carry trade situation was kind of a perfect storm that in a super low volatility environment, it just kind of lit a match.
We tend to get those perfect storms like once every few years, like clockwork. I want to get to our word of the day because this kind of encompasses what we're talking about here today. It is hedge, a word that I know is near and dear to your business here, Trent. A hedge is an investment strategy used to reduce the risk or the risk of adverse price movements in an asset. It typically involves taking an offsetting position in a related security using derivatives such as options or futures to protect against potential losses in an investment portfolio. So you want to protect against losses. What does hedge mean to you?
Just that. I mean, you can hedge by raising cash. So if you have 90% of the portfolio invested, you can trim some positions going into volatile periods, or like you said, you can use derivatives such as futures or put options to hedge the downside risk.
Let me ask you, the term hedge fund, do hedge funds hedge? What is the deal with what they're called?
It's a bit of a misnomer there. Some of them do. Some of them are, there's umpteen hedge fund strategies out there, but a lot of them will take both long and short positions, either through shorting stocks outright or using derivatives or finding assets that are either not correlated at all or inversely correlated with the majority of their long holdings. But the term hedge fund, it's just kind of a strange use of the word. Yeah, because some of them don't hedge. Some of them are long only. So it just basically means they can charge 2 and 20.
I want to ask you about some of the hedging that you do on behalf of some of your clients. You and I met at a CMT event. That's the Chartered Market Technicians. And way back in the day when the futures markets were invented, ostensibly it was for this purpose, to hedge physical crops or maybe oil production or something. Tell me the services you provide to these small farmers who are pretty much disappearing.
Sure. So if you're a farmer and you are going to be harvesting and then selling your crops later in the year, and then let's say it's March. To lock in that price, you can basically go into, we'll just use corn as an example. You can go into the futures market, sell futures short in basically in a balance that would offset. So if you have 100,000 bushels or 200,000 bushels or whatever it is, you go in and short the number of futures contracts you would need to cover that position, thereby basically locking in your gains that you will look to sell the physical commodity in the fall.
And you can actually do that on the opposite side. You don't necessarily do this, but if you're buying the grains or you want to buy the oil, you can lock in a future price as well.
Exactly.
Tell us, lots of strange things going on in the market now, but just tell us on a day-to-day basis, what are some of the concerns that you see and some of the surprising things you see in the market right now?
Yeah, so I think we've come to the point now where the Federal Reserve, who has a dual mandate of both price stability and full employment, the focus for the last 2 years, and for good reason, has been on the inflation part of that. I think the scales have tipped now that they need to be much more focused on the employment piece of that.
Yeah, we're watching those jobless claims this week and seeing if they spike higher.
And knowing full well that, not maybe in every circumstance, not right away, but AI is going to change the jobs picture as we know it. And when you see these jobs start piling up, the job losses piling up, you start to get a little bit concerned that you can't just turn this ship around right away. Just like when you raise interest rates, it takes time for that to flow through the system.
The long and variable lags.
Exactly. There's long and variable lags on the opposite side too. And
so with some of this changing picture that we're seeing with the, surge of AI, potential rate cuts in our future, kind of something with some job losses that we're seeing, how should investors think about hedging their portfolio, especially maybe early investors, people who are kind of just starting out and don't know much about how to handle some of this volatility and changing landscapes?
Sure. Yeah. For a younger investor, I think the best thing that you can do, if we're talking somebody that maybe just got their first job, you really don't have a lot to worry about. You've got 20, 30, 40, 50. I mean, if we keep going the way we're going, the average life expectancy will be 90 or 100 years old. They've got 70 years to invest. If you could go back 70 years and invest in the S&P index, I don't think there's always going to be tumultuous times in markets. But if you look at long-term returns, on average, just using the S&P 500, you can bet somewhere between 8 to 10% annualized per year. Sometimes it's lumpy. Sometimes you get 30% a year. Sometimes you're like 2022, you're down 20%. But if you're using a dollar cost averaging strategy over time, young people don't have anything to worry about. It's the people that are nearing retirement and those that are in retirement that they want to take a little bit more caution. Maybe invest in bonds. Maybe if they've got a 60-40 allocation, maybe they do 50-50. Well, it makes them uncomfortable.
So who is 60-40 really for?
So is young people don't need bonds or just later in life? How does that work?
Yeah, I mean, I would personally say young people don't need bonds unless they get extremely uncomfortable. But if you're a young person and every 2 weeks you get paid by your company, if you're lucky enough, you've got a 401k and you've got a company that will match a certain percent of that. You want the market to go down. And bonds are there to reduce the volatility of a portfolio. But if you're young enough, really none of that matters. You should want the market to go down because every day that you get paid, every 2 weeks, you get to buy more and just keep buying.
Well, so sticking with this younger investor then, do you just pour your money into something like tech at that point and hope for a lot of growth? Because obviously you have a long runway until you need that money.
If you're shunning bonds, do you do the opposite? Do you just go all in on high beta?
It's a good question. I think it kind of comes down to the individual's personal, maybe risk tolerance. If you're somebody that finds yourself watching stocks move day to day, week to week, month to month, and that makes you uncomfortable, you can do things like invest in maybe large cap only, or invest in individual sectors, like maybe in the XLP, like the staples or healthcare. Generally, those are industry sectors that exhibit a bit less volatility than your high-tech sectors, XLK.
I have an odd follow. If you're someone that's only let's say you're a young investor, you don't know that much, you're investing in ETFs, it's kind of, you're just tracking the major indices for the most part. Like, do you just keep piling into those same ETFs? Like, I understand, okay, diversify, but if you're if you're kind of going into, oh, okay, this large cap ETF, this other large cap ETF, should you pile into one? Do you diversify even within that? How does that work?
Yeah, so if you buy a general ETF like the SPY, basically you're getting the 500 largest in terms of market cap companies in the S&P. As time has gone on, I can't remember, before it was, everything is getting more and more heavily technology weighted, and for good reason. But years ago, energy was a much bigger portion of that. So I don't think you want to have all of your eggs in one particular sector. Now, if you're super young, I would probably steer clear of things like the utilities. I don't think you really need too much exposure there. But I would just think of themes that will be present throughout somebody's lifetime. Technology will be there. Healthcare in the aging population will be there. XLV. Staples will be there. Doesn't matter what the world does, we're all going to buy toothpaste and soap and all that boring stuff.
Except if it's the apocalypse.
Then your money's not going to matter anyway.
Stock market's not an issue.
Exactly. You will have bigger problems.
All right, we got to take a short break here. Coming up, we are going to be talking AI capex, what the largest tech companies are spending on AI this year, and in Out of This World, who wore it better, searching for unidentified financial opportunities. All right, this episode is brought to you by the number 199, as in billions of dollars. That is the total estimated 2024 capital expenditures, or capex, by Amazon, Meta, Microsoft, Alphabet, and Oracle. And that's what the street thinks they will spend on artificial intelligence research this year, up 28% from the prior. Trent, the money is starting to get real here, $200 billion, and that's just what they're spending on research, basically.
Right. And we saw it first and foremost in I believe it was the first quarter of 2023 last year with the huge boom in new sales at Nvidia.
Mm-hmm.
And that is going to continue. I kind of picture this huge, it's an infrastructure build out for the next wave of technology and artificial intelligence. That doesn't take place over 1 quarter or 2 quarters or even 1 or 2 years. This is a massive build out that's going to take more and more time. And you just have to kind of listen to, if you're super interested in this stuff, like obviously we are, listen to a lot of conference calls, because there is no better way to get information than listening to the management teams, because they listen to Microsoft, listen to Andy Jassy at Amazon and Jensen Huang at Nvidia. They tell you where this is all going. And to the extent that you can forecast this stuff, I don't see it slowing down anytime soon.
By the way, you mentioned earnings calls. If you want to find an earnings call, you just type in the company name like Microsoft Investor Relations, take you to that section of their website, and you can see the schedule there. Sometimes they have a password. Sometimes it's hard to get on, but for the most part, that's how it's done.
Yeah. I recently read that capex is kind of like a way to return capital to shareholders. But how does that work? How does spending money return value to shareholders?
Like dividends or buyback.
Mm-hmm.
Sure. So if you look at an individual company, capex, generally what they're referring to is to just the capital expenditure. So they're taking the top line revenue growth. So say they grew at 10 or 15% year over year. They're taking that and they're investing that into expanding their business. It's a build out phase. And we're just starting to see in a couple companies some of the benefits that are just beginning to pay off in this investment. But assuming that you can take that revenue growth and invest it back into your business, and the management team is very competent in terms of capital allocation, if they can invest that back into their business at a high rate of return, that's where compounding comes from. So if anybody who's taking an intro to finance class, they talk about.
I'm taking it right now.
Oh, good for you.
Good for you. Well, you're going to learn
That's
about
news to me.
compound interest.
No, I meant right now
Oh, okay.
in
Yeah.
this very podcast.
That's news to me too.
So one of the most important things, and this, I don't know why, maybe because it just gets kind of into the weeds and it doesn't make for good TV, but if you find a company, the first thing I look for is return on capital. There's several metrics with this. There's return on equity, there's return on invested capital, or ROIC. There's return on capital employed, which is ROCE. Look at those things first, and the percentage that you get kind of on a normalized, just take maybe a 3 to 5 year scale. If that's above their cost of capital, it's a mathematical certainty that this company is going to generate value and the stock price will follow in time.
I find that interesting. If you're trying to invest in a single stock, is that your advice to look at these numbers before you invest?
Which are available on Yahoo Finance website, by the way.
They are.
All of them, yeah.
They are.
But what if you're not? What if that doesn't come easy to you?
Sure. So if that stuff doesn't come easy, invest in an index. That is,
don't do it if
There's
it
no
doesn't
shame
come.
in going passive.
Yeah.
I'm from Omaha, so even probably the greatest investor of all time said the vast majority of people should index. And for the most part, I agree with them. The vast majority of people, unless you have a real interest in this stuff and you want to get into the accounting weeds and capital allocation weeds and so forth, most people, and you'll do just fine. If you save more than you spend and you invest over a long period of time, it will work.
Going back to capex, wasn't there kind of like a recent scare from Wall Street where people were worried that AI wasn't returning revenue kind of fast enough to these companies?
Ask Microsoft about that one, little co-pilot.
Yeah. We are really, really impatient people.
That's an understatement.
In everything. If you want to build muscle at the gym, you want it to be in a week. If you want to lose weight, you want it to be in 2 days. If you want to study finance, you want to read one book and then you know everything. And life doesn't work like that. And although I think this is going to start playing out maybe sooner than people expect, it's like we started to see the investment last year, and boy, we better see some return on that investment right away. Like, guys, if you're building infrastructure, roads for a new city, they're not going to be flooded with cars immediately. It's going to take people some time to find their way around. And so it's coming. It's coming.
All right. Hold that thought. We want to keep it on that track. On this episode of Who Wore It Better, we are blasting off into new frontiers with out-of-this-world investments. We've got space tourism, space exploration, quantum computing, clean energy, 3D printing, artificial intelligence, not just sci-fi fodder anymore. No, these are cutting-edge sectors where real money can be made. But who is leading the charge here? Are space stocks shooting for the stars, or does the future belong to AI? What is the next big unidentified financial opportunity, or UFO as we are calling them, Trent?
I love UFOs. There's a company out there. We don't own this, and it's not going to fit the mold of our fundamental criteria, but one that it's called Rocket Lab. It's going to be fun to keep an eye on it, just to see what they can do. The problem with this higher interest rate environment that we found ourselves in, and the lesson a lot of us got taught in 2020. When I started in the business, it was 2006, and by and large, that entire time, rates had been fairly low, abnormally low for a very long period of time. So you had to pay almost no attention to valuation, and you didn't have to worry about the kind of the debt to equity ratios in these companies' balance sheets. But as rates start to come down and the cost of capital goes lower, there's going to be some really incredible things like space exploration, like the solar industry, hoping to be able to get back on some solid footing, because there's a real need for energy infrastructure, electricity, and power generation. So those are the places I would kind of focus on to keep your eye out for as rates come lower.
How do you go about picking, like, to me, space tourism, that's like a unique sector, if we want to call it that. Like, sure, we have consumer discretionary, we have materials, those are like set S&P sectors. How do you kind of decide to wade into investing in something like space tourism?
Probably the same way that you would decide whether or not to take a space tour. I mean,
pay a lot of money.
I mean, right now it's very risky over time. We may, with the benefit of hindsight, in 10 years, we may look back at this show and be like, boy, what are the opportunity of a lifetime. At the time, it seems super risky. We're in a high interest rate environment. These companies were just getting started in a very difficult place for a brand new startup to get going. But who knows? I mean, I would try to find I'm not aware of one, but I'm sure there's already an ETF for this. And just keep an eye on the companies, the holdings within there, and just kind of see who becomes the forerunner.
Would you travel to space?
I don't think so.
No?
No, I'd get homesick.
Yeah. It's scary.
Yeah.
I have another question. So you look at both technicals and fundamentals. Most of our guests tend to focus on one or the other. How do you use them together?
So the fundamentals lead me to the what. In other words, if you're going to invest in individual businesses, and I say invest, different than trade. Very, very different. I've done both. I do some of both. The older I get, the less I trade. The more I focus on the investment.
Is it attention? Like, how do you differentiate those two words? Because I think that's kind of important here.
Yeah. So I think it was in Seth Klarman's. So Seth Klarman, CEO of Baupost Group, brilliant, kind of from the school of Buffett. He had a book called Margin of Safety that is out of print. If you can find it on Amazon or eBay, it's like $10,000 or $15,000. I was lucky enough to get my hand on a copy last year because the Columbia Business School library had it. And how he kind of identified trading was guessing what the next guesser is going to guess. It's just if you can guess better.
Yeah.
And so as a trader, I just tell people, if you're a short-term trader, don't bother with fundamentals because you're kidding yourself if you think the fundamentals of these businesses are changing tick by tick or by a 15-minute
You might get some volatility
chart.
off an announcement, but
Sure.
that would be the limit.
Sure. Yeah, trading for income and investing while you might be using the same vehicles, they're two totally different things.
Is it smart to trade if you're a young investor? I mean, sure, I get that you have to kind of measure your own risk tolerance, but do you think it's a good move for people who have time to try it out?
Yeah, I mean, I certainly did. And I would say that if you are interested in trading, do it with a sum of money that you're okay losing. And don't commingle the two things. If you're an investor and you're just starting out, The foolproof way to get where you need to be is to dollar cost average into index funds. It will not fail you over a long period of time. Trading will fail you.
Yeah.
It fails almost everyone. There are
the
some
day
people that are
trading
very good at it.
statistics are horrible.
Horrible.
Something like 95. It's more than 95% failure
Sure.
rate within 1 year. Accounts getting wiped out. I want to ask you. We got about another minute here. You studied mixed martial arts in college with some people who would go
Sadly.
on to be in the UFC. How was that?
Not one of my better judgments at the time, but I worked out at a gym in Omaha, Nebraska, and a good friend of mine taught a mixed martial arts class at that gym. And I was working out one day. He's like, why don't you come join us? And I was like, that seems like a good workout. Good cardio, good strength training. And I come to find out, somebody walks in and they're like, you know who that is? And I was like, no. They're like, oh, he just had a UFC fight a month ago. And I was like, he's your partner today. And I was like, excuse me?
No.
Yeah. And so I got roughed up pretty quick by real fighters and found out pretty fast that it wasn't something that I would be pursuing. That's not a long-term viable strategy.
No,
I don't think so.
But investing is. There we go.
Correct.
We got to leave it there. We have wound things down here at Stocks in Translation. Make sure to check out other episodes of our program on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms: YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. Signing off.
And that does it for Wealth. I'm Brad Smith. Thank you so much for watching. Stay tuned for Market Domination with Madison Mills and Josh Lipton coming up at 3 p.m. Eastern. You don't want to miss it.